New York City, I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Good morning, everyone. Stock futures right now, they are higher across the board for the Dow, the S&P 500, and the Nasdaq. Wall Street looking ahead to rate cut commentary from Fed Chair Jerome Powell out of Jackson Hole on Friday here. Now let's get to it with the three things that you need to know to start your trading day. Yahoo Finance's Jennifer Schonberger, Jared Blickery, and Rick Newman have more.
Fed officials are descending on Jackson Hole today for the Kansas City Federal Reserve's annual economic symposium. All eyes will be on Federal Reserve Chair Jerome Powell as he gears up for a critical speech Friday at 10 a.m. Eastern, where investors will be looking for clues that rate cuts are coming. As inflation shows new signs of cooling, the job market weakens and investors worry about a recession. The question in markets isn't whether the central bank will cut rates in September, but by how much. Traders are currently pricing in a 70% chance of a 25 basis point rate cut and a 30% chance of a 50 basis point cut.
And we're getting a new read on the labor market. Initial jobless claims for the week ended August 17th shows 232,000 people filing for first-time unemployment benefits. Now that's in line with what economists expected, and it's an increase of 4,000 from the previous week's revised levels. Wall Street is digesting a mixed picture of the labor market after the July jobs report showed fewer jobs added than expected and saw the unemployment rate tick up to 4.3%. Investors using signs of a cooling labor market to bolster the case for the Fed to start cutting.
And Tim Walz officially accepted the Democratic nomination for vice president Wednesday night at the Democratic National Convention. Vice President Harris's running mate talked about a number of subjects: his upbringing in a small town, his life as a teacher and football coach, his military service, and his wife's struggles with fertility treatments. Weiss also touted Harris's economic agenda.
If you're a middle-class family or a family trying to get into the middle class, Kamala Harris is going to cut your taxes. Kamala Harris is going to take on Big Pharma. If you're hoping to buy a home, Kamala Harris is going to help make it more affordable.
The DNC closes out tonight with a speech from Kamala Harris as she accepts the Democratic nomination. We can expect to hear about her economic agenda and vision if elected president.
High expectations on this Thursday morning. The next test for the markets, commentary out of Jackson Hole, Wyoming, where the Federal Reserve will hold its annual economic symposium over the next few days here. Now, traders, they're pricing in a 100% chance of a rate cut in September. The depth of the cut, though, is what's up for debate. Yahoo Finance is in Jackson Hole to cover this important event. Our Fed correspondent, Jennifer Schonberger, is live on the ground. Hey, Jennifer, good morning.
Good morning from a chilly Jackson Hole, where Fed officials are descending here on the Jackson Lake Lodge in the Grand Tetons for the Kansas City Federal Reserve's annual economic symposium, a confab dating back to 1982. This year, the theme is reassessing the effectiveness of the transmission of monetary policy. It will delve into how effective monetary policy's response has been to the pandemic and the subsequent surge in inflation. While this is largely an academic conference, this year, Fed Chair Powell and his colleagues will face a very different question than last year. Last August, the Fed was looking at how long to hold rates at two-decade highs to bring down inflation. This year, as inflation shows new signs of cooling, the job market weakens, and investors worry about a recession, the question in markets isn't whether the central bank will cut rates in September, but by how much. Traditionally, Fed chairs have used their Jackson Hole speech to deliver an important policy message or to dig deeper into a more academic topic that pertains to the current economic environment. Back in 2022, Powell gave probably the shortest speech of any Fed chair, driving home the Fed's intent to bring down inflation and sending markets down more than 3%. In contrast, his speech in 2018 outlined how he thinks about the neutral interest rate, the rate that neither boosts nor slows growth. Former Fed Chair Ben Bernanke used Jackson Hole to lay out QE. This year, Powell could take the opportunity to delve into a bigger research topic, kind of take a step back, perhaps to something that is germane to the economic environment, while also signaling clues for a September rate cut. Back to you.
All right, Jennifer, thanks so much. And of course, you can catch Yahoo Finance's coverage of the Fed's economic symposium, all kicking off tomorrow with a speech from Fed Chair Powell. That's at 10 a.m. Eastern time. Jennifer is going to be speaking with a number of these key guests on the ground, former and current Fed officials, including Cleveland Fed President Loretta Mester, former Fed Vice Chair Alan Blinder, Philadelphia Fed President Patrick Harker, and Atlanta Fed President Raphael Bostic. We'll also get reaction from the IMF, and we will also hear from the White House. A great lineup here for you on Yahoo Finance over the next 24 hours. All right, well, the stakes are certainly high for Fed Chair Jay Powell, but what exactly is Wall Street hoping to hear? What tone should Powell be striking? Market strategists have been helping us answer that question.
Jay Powell is not going to really show exactly what they're going to do in September, although he may lean towards being more dovish than not.
We don't want any surprises. I mean, the markets have had a very strong comeback from that August 5th sell-off.
I think what he'll say is, you really should have listened to what I last said at the end of the last meeting, where I conveyed the sense of my colleagues. The economy has some momentum. Inflation is declining. That's welcome, but we can't put that in the bank.
All right, well, let's put that question to Brian Jacobson. He is the chief economist and strategist at Annex Wealth Management. Brian, it's great to have you here. So certainly there is a lot riding, it sounds like, on Powell's speech tomorrow. What do you think? Is he going to be dovish enough for the markets, or is he set up almost just to disappoint investors?
Yeah, thanks for having me. Here at Annex, our investment committee, we've been looking at the history of what he has said at Jackson Hole and the evolution of his messaging since the last time that he appeared. And the market might be having too high of hopes for what he might actually say. In a way, expectations are so high, maybe he's actually doomed to disappoint. I really loved the reporting that you had at the beginning, going through some of that history in 2022, talking about how there will be pain was kind of his big message there. 2023 was about them trying to figure out when is monetary policy restrictive enough. Now, the messaging might be along the lines of, you know what, we can actually reduce the interest rate, the federal funds rate, without providing monetary easing, simply because inflation has come down. So they're really focused on inflation-adjusted interest rates. And as inflation has come down, that policy rate should also be coming down. So in a way, maybe it's going to be a little bit of a disappointment for people who are expecting a big message about monetary easing, because it's just about trying to keep policy from becoming more restrictive as inflation continues to trend towards 2%.
I mean, is that because of, and that set up for disappointment, is that because of over anticipation, or is it because of the reality that we're starting to wade into, where bad news is actually becoming bad news, and good news is finally good news, I guess, here? What's your kind of calculus that you're running there?
No, you're absolutely right. Where it did look like bad news was good news, mainly because the bad news for the economic data was almost like saying something bad about the Fed. So bad news is always bad news, and good news is always good news. It just depends about what. And it's oftentimes about what is the Fed likely going to do as it relates to that data. So when we had really strong growth, that was good news. It was bad news for the markets because it meant that the Fed would hold rates higher for longer. Now it's a little bit different, that the Fed is poised to start cutting. But the problem is that sometimes rate cuts, you have what's called a J-curve effect, where when they start cutting rates, people might actually sit on their hands saying, let's wait for those rate cuts, for a few more of them, to make it actually make sense to borrow more money or to refinance a loan. Because it's not necessarily the first cut that is really going to help the economy. In fact, it could actually hurt by actually lowering the interest income that savers get. So the benefit takes actually months to be felt in the markets and the broader economy from those cuts. At first, there's a little pain.
So, Brian, what does that then look like for the setup here for growth? It sounds like it could be a challenging time here then over the next several months.
Yeah, that's our expectation, is that while we don't think we're going to be going into a recession, we've gone basically from great growth to good growth to sustainable growth. When you get those cuts, the market is pricing in a reacceleration of growth as you go into the fourth quarter. And there are lagged effects to the monetary policy where you might not actually see those benefits until maybe 12 months from now. So the fourth quarter, I think a lot of people have high hopes about a relief rally after the election, no matter who wins, from the rate cuts. Maybe the economic data isn't necessarily going to support that.
Okay, and so let's lean further into that strategist hat. Where are you kind of continuing to put your eggs in the market basket? Is there a certain sector right now that you're kind of overweighting and leaning into, anticipating what the Fed may do here?
There are. And from a sector perspective, we do like some of those cyclical names, like in more industrials, financials. That's more of a valuation play, and the idea that the market for those areas has already been pricing in a recession, because the market has been pricing in boom times for tech, but recessionary periods for some of those cyclical areas. Consumer staples is not necessarily cyclical, but it's another one where people were, I think, caught off guard with the reports from Walmart and from Target, even though Target is technically in consumer discretionary instead of consumer staples. It's a weird way that they do the classifications. But a lot of people have almost said, okay, well, we're going into recession. That's been reflected in some of those stock prices. Others, it's pricing in boom times. So we're looking more for where is a recession or slowdown already priced in. So industrials, financials, energy, those are a few of our favorite places as far as for fishing for opportunities in the sectors.
It's because we call them Target that they fall into the discretionary side of the equation there, Brian. All jokes aside, great to have you here with us this morning. Brian Jacobson, who is the chief economist and strategist over at Annex Wealth Management. Thanks. We've wrapped up day 3 of the Democratic National Convention. Minnesota Governor Tim Walz formally accepted the party's nomination for vice president last night. Walz had a lot to say about what a vote for Vice President Kamala Harris and Democratic presidential nominee as well, Harris, could mean for middle-class citizens. Let's listen.
If you're a middle-class family or a family trying to get into the middle class, Kamala Harris is going to cut your taxes. If you're getting squeezed by prescription drug prices, Kamala Harris is going to take on Big Pharma. If you're hoping to buy a home, Kamala Harris is going to help make it more affordable. And no matter who you are, Kamala Harris is going to stand up and fight for your freedom to live the life that you want to lead.
So why does this all matter, and what impact does this have on the election? Here with his big takeaway is Yahoo Finance senior columnist Rick Newman. He's been keeping tabs on all conventions everywhere, especially here in the U.S., so that we don't have to some days. But what did you make of this?
Does it have to be a big takeaway? How about a medium takeaway?
Okay.
This convention's going well for the Democrats. I mean, it was well staged last night. It ended mostly on time. We got the vice presidential brouhaha out of the way, so now we know we've got it. We've learned who the vice presidential nominee is, and it's all about Kamala Harris now. So I think Tim Walz, I think they did a good job of making him seem normal. It was a nice touch that they had a bunch of his former football players up on stage. I mean, you know, I think it's an overused term, but relatable applies to this guy. The footage of his 2 kids and his son, he's like, wow, that's my dad up there. I mean, quite a contrast from the Trumps sitting in their box at the Republican convention, you know, just sort of nodding at the coronation of, you know, dad all over again. So now we move on to Kamala Harris. We're not going to hear a lot about policy tonight. She still has to introduce herself to people. There's still a lot of people who, you know, everybody knows who she is, but people want to know, what does she stand for, what is she like, and I think that's what we're going to get tonight.
Rick, what do you think her message needs to be going off of that, just in terms of the best connection here, or the best way to make that connection with voters?
So one of the things that has solidified out of this convention is we are now seeing what the Kamala Harris campaign messages are. Number 1, joyful warrior, and I think that is effective. If it could be very effective if it sticks and if that connects with voters. I mean, it's a huge contrast from the Biden campaign, and you have to think that it's mostly the same group of people running this campaign as were running the Biden campaign, and yet they've obviously completely shifted the messaging, and it's been pretty seamless, honestly, kind of impressive. They're using the theme of freedom. So That's normally a sort of a MAGA or conservative Republican theme, and they're trying to steal it from MAGA world. And they're applying it obviously to reproductive rights, abortion, but also to other things, the freedom to get ahead, the freedom to have the government not tell you what to do. So there's that. And then there's going to be some economic populism. I mean, that's just what we get these days. But again, we're not going to hear too many policy ideas. We're going to hear generalizations, help the middle class get ahead. If she has to do anything, I mean, the weak spot for Kamala Harris, just as it has been for Joe Biden, is inflation. So she needs to persuade voters that she is going to be different from Biden, and they don't need to think of her as an inflationary politician the way they do think of Joe Biden as that.
All right, we will wait and see what we hear from Kamala Harris tonight. All right, Rick, great stuff. Thanks so much.
See you.
Taking a look at Snowflake, shares are plunging this morning. You're looking at losses of nearly 10% in the pre-market. Now, the cloud-based data platform failing to reassure investors that it's making enough progress in the artificial intelligence space in the second quarter. Earnings report. Now, Snowflake boosting its full-year guidance, but it did signal a bit of a slowdown here. At least that seems to be the crux of the issue here with the street, Brad, as we take a look at those losses of just about 10%. So once you dig into this report, pick out some of the stuff that really stuck out to me. Yes, they are launching, or many of their launches when it comes to products that they are going to be rolling out here over the next several quarters. It is focused on generative AI, other new ways to analyze data sets. But I think the big question is how Snowflake is stacking up to some of its rivals out there. When you take into account specifically some of the progress from Databricks, I think there is some concern, and I think that's a big reason why we are seeing such a loss today, just about the fact that they may be at a disadvantage when it comes to how their products today currently stack up to some of their rivals right now.
Yeah, I kind of boiled this one down to three things for Snowflake. One of them was the runoff of storage revenues. I'm going to start with the nerdy one just to get this out of the way, because this is something that a lot of analysts focused on in the call, and this could perhaps still represent 11% of revenue. So if the pace of that runoff impacts the guidance, that could lead investors to continue to look into the future and the forecasts that Snowflake is putting forward and try to really get ahead of any slippage that they see in that part of the business. Secondly here, the deal flow. It's tough in the IT spending environment right now. The chief financial officer, Mike Scarpelli, he talked about this on the call, but he did say that from an order standpoint that things are kind of normalizing. Stop me if you've heard that before over the course of this earnings season, especially when it comes to some of the cloud or ERP companies. They're looking for this normalization period. The question is, does normalization still carry growth on the other side of that normalization, at least in deal size? That's going to be something to focus in on here, and they might lean a little bit more into the services and how they can get more services revenue out of their customers. And then just lastly here, they had to talk about the cybersecurity data leakage headlines as well. They addressed that on the call, saying that they understand when it comes to cybersecurity, we're all in it together. Their one ask, and get this, of all businesses around the world, whether a Snowflake customer or not, just enable and enforce multi-factor authentication. I thought there would be something stronger that they would lean on, but it's actually something that I could just do with my phone and my computer. We use a different system, but all things considered, that's what you heard on the call.
All right, well, Snowflake shares, not enough for the street, off just about 10% here ahead of the opening bell. Keep right here on Yahoo Finance. Coming up, Peloton shares rallying after the company reported its first quarter of positive revenue in over 2 years. You're looking at gains of just about 10%. We've got that and more when we come back.
Let's get to our top trending tickers today. We've got to start with Peloton here. Shares of PTON, they are in rally mode. The company ending an over 2-year streak of revenue declines, slashing its overall losses. It's been a rough go of it, rough ride, if you will, for Peloton to say the least. Shares have fallen over 40% this year, and demand for the company's products have taken a massive hit since the end of the pandemic. Let's bring in Bernie McTiernan, who's the Needham Company Managing Director for Analysis. Bernie, thanks so much. I mean, you're fresh off the call. What did you hear from these executives? What's the vibe, if you will, of how they're navigating this environment right now?
Yeah, well, I think the key is part of the setup and what you mentioned, the stock down 40% year to date. So there was definitely some balance sheet and liquidity concerns. The company shored up the balance sheet in May with some refinancing, and then they just announced EBITDA and free cash flow targets double of what the street was expecting. So I think that's why you're seeing the stock react positively. What's interesting, though, is that they're still guiding to it, even though they got to revenue increase in the fiscal fourth quarter, they're still guiding to a 9% decline in revenue, a 9% decline in subscribers in 25, as they're looking to optimize that LTV to CAC equation. But, again, I think it's the doubling of the EBITDA versus expectations, doubling of free cash flow versus expectations is what is winning out in the market right now, given those prior balance sheet and liquidity concerns.
So, Bernie, what does Peloton need to do in order to keep this momentum, right? And that is the multi-million-dollar question that so many investors are asking themselves right now. And even, I'm sure, just within inside Peloton, as they search for that new CEO, is there enough confidence, do you think, from the street that they are going to be able to maintain that momentum? And what does that turnaround then more specifically down the road look like?
Yeah, well, that's why, generally margin beats aren't treated very favorably by the street. And so, I mean, the key is getting revenue back to where the trajectory of where, Barry McCarthy, prior CEO, was looking for, where he was willing to take the margin hit near term to really grow that subscriber base and gain enthusiasm. And so that's what the company's working on right now is basically the opposite. It is really trying to refine that LTV to CAC equation, because ultimately this business can't be, declining 10% revenue growth forever. They need to get back to growth at some point. They did mention the macro weighing on their outlook. And so I think that's ultimately the key. There was some green shoots, though. They talked about Tread revenue was actually up 40% year over year in the fiscal fourth quarter. So that was certainly great to see. So I think it's finding these green shoots and these pockets that they can go after, waiting for the fitness market to continue to come back. And again, all the while refining this LTV to CAC equation, making sure that they're on sides here when they get back to growth, because they said LTV to CAC right now 1.5 times. They want to get that back to 2 to 3 times where they've historically been.
Bernie, when we're talking about the new CEO, from the street's perspective, any idea just in terms of internal versus external candidates, or what more specifically investors are looking for in that new leader?
I mean, it's tough to say. We'll have to see. The commentary we did get from the company is that they are making progression. There's lots of demand. I'm assuming it's an outside candidate, but to be honest, they haven't discussed much of it. And so what would the street be looking for? Look, this company has to show free cash flow growth, has to show continued margin expansion. And then you need a growth strategy as well, too. So it's really threading that needle, which is difficult to do when the end market for this company has been so treacherous, really, over the past 2+ years.
Bernie, are the rise of what I see on social media, what I see among friends in the run clubs and the biking clubs, and these more social constructs for exercising, is that a potential, and I don't want to say this, I hesitate to say this, but is that a Peloton killer right now?
Yeah, no, look, it's a good question. And there's certainly companies like Whoop and Aura where there is some sort of a network effect where, you have friends checking their sleep scores and whatnot. Look, at the end of the day, I still think that connected fitness, at home working out, it's cheaper than many other options. I mean, if you think about, a $45 subscription versus a $45, Barry's Bootcamp class, getting that subscription for the month is pretty powerful. And also the amount of time that you save too. So, I'm still one of the 3 million Peloton connected fitness subscribers. And I just think about the amount of time and money that I'm saving. But certainly there's other options coming about here, but Peloton is clearly, what's their network effect? It's the fact that they can, it's the amount of content, it's the quality of the content that they have too. And ultimately we've seen that win out in other industries. And we think that that should ultimately win out in fitness as well. But also, this is just a tough go for the company at this moment in time.
Bernie, you and me both. I'm still one of those subscribers, and it does save you a lot of time and a lot of money, certainly when you compare it to berries or some of those other classes that cost a lot more. All right, Bernie McTiernan, thanks so much. Always great to get your insight. Needham Company's Managing Director for Analysis. Thank you.
Thanks.
Let's take a look at Baidu, the Chinese internet giant, reporting relatively flat second quarter revenue. Economic conditions in China weighing on advertising spending. China's economy still recovering from that property slump that we've been talking a lot about, and that actually prompted advertisers to tighten their budgets. Not necessarily a huge surprise. You're looking at declines of just about 2%. And also remember that this is consistent with some of the Chinese e-commerce giants or Chinese giants that we have heard from so far this earnings season, just in terms of the tough times, challenging times that they are up against. Now, for Baidu specifically, it's a bit of a different story. Yes, they are struggling with the sluggishness within the Chinese economy. Obviously, that is weighing on their business. But also remember that they are transitioning from search ads to AI, and they're doing this during the economic downturn within China. They have seen some traction when it comes to ERNIE, their large language model, but it's not offsetting those, troubles elsewhere there. So I think the question is for investors, how long this transition is going to take and whether or not Baidu is going to be able to regain momentum before the end of the year.
Yeah, they're really trying to speed up the AI native transformation of their products, and they talked about this in the second quarter as well, really pivoting a lot of their operations towards that effort with things like ErnieBot. You've also got the expansion that they're talking about within this AI cloud of what they call paddle. I didn't know too much about that going into this quarter, but now we've got a little bit more of an update. The developer community, and this is what it's going to hinge on, the developer community can continuing to lean into how they can leverage these language learning models, build on top of them, and ultimately put out more applications. Because let's remember, it's the applications that sit on top of the models, that sit on the top of the chips there. So all of these things considered, the developer community growing to 14.7 million as of June 2024. So we'll continue to track that very closely as well. We're also tracking Zoom here this morning. Zoom Video it is. Shares are moving higher after the company raised its full year revenue outlook thanks to strong demand for its AI-powered tools. Shares right now are up by about 2.8% pre-market after reporting this earnings report, or this earnings release, rather.
Yeah, I think the takeaway, at least for me, is what they're seeing, the traction within their business clients. We know business customers has certainly been a priority with Zoom as they try to regain some of that momentum that they lost from the peak of the pandemic. So when you take a look at this, they are actually gaining there. They're talking about the fact that they have rolled out or plan to announce more tools, which include that phone systems, the contact centers, AI assistant. Zoom had 191,000 just over enterprise customers, including just under 4,000 contributing more than $100,000. So again, that does mark some progress within Zoom's business and is viewed as a positive catalyst here for the stock going forward. And another, just very quickly, their CFO stepping down as well at the end of October, and they're saying that they are underway here in terms of a search for a successor. So again, a change there in the C-suite, something to note with Zoom.
All right, everyone, we're trending towards the opening bell on Wall Street and in Midtown Manhattan. Wow, you've got ALS United ringing the opening bell at the Nasdaq. Yeah, go ahead, press that button, get this trading session started. And at the NYSE, you've got Gap ringing the opening bell. They've got a new ticker symbol there. Used to be GPS, now it's more fitting to exactly what the company is and how they spell their name, Gap. Our own Brian Sazzi is going to be down there later on speaking with the company, so stick around for that conversation this morning here. All right, two great bell ringers, and we've got a great look at what the major averages are doing out of the gate here this morning as we were tracking those. The Dow, the S&P 500, and the Nasdaq here at the opening cross, opening higher across the board right now.
Yeah, you got the Nasdaq up just about 0.5%. Jared Blickery is staying by at the big board with a closer look at today's gainers. Jared.
That's right. Nasdaq outperforming, but I want to take a look at the S&P 500, which is now under 1% away from its record high. And that record high was in July here, and it's probably just a fraction of that right there at the Rubicon. So we'll have to see. I wouldn't be surprised that we get some kind of headline today, record high for the S&P 500. But we already have one when you you consider the equal-weighted S&P 500 index. That's where every stock gets one vote. We got that 3 days ago and yesterday, and it looks like we're getting another one pretty soon here. So I want to take a look at the U.S. dollar index as well. That has been falling, although today it's bouncing just a little bit. But I want to show you a longer-term chart. It came right within this area where you would expect to find support. Thought it might have bounced a little bit sooner, but nevertheless, this is something to track because a rising dollar is a headwind. And even on this latest decline, I would note that crude oil was not able to capitalize on that. If we have some time, I'll circle back around to crude. But first, I got to get to the sector action. And today, it is tech in the forefront. Also, healthcare outperforming. Industrials was leading pre-market. It's in the middle of the pack now. Even materials just briefly flashing green right there. And I want to check in on the semiconductors because the semiconductors have been coiling for a move potentially higher. Let me just show you what's going on with Nvidia. This is going to be a 2-month chart, and I'll put some candlesticks so you can see it is also very close to its record high, which was also back in July, and it had a little bit of a triangle consolidation, and it's now breaking above that. A lot of times that will just add to the momentum to the upside, so wouldn't be surprised to hear about Nvidia making another record high in the coming days. But not to get too far ahead of ourselves, I did promise some crude oil action, and here we are looking at a lot of red on the board. As I said, the U.S. dollar really not doing much. It's up a little bit, but here's crude. As the U.S. dollar has been sinking, that should have been a tailwind. The opposite was happening. And so I'm just a little bit concerned about the global demand picture for crude oil. This would be a logical place for it to reverse, 72, but we'll have to see what it does in the coming days, guys.
We certainly will. All right, Jared, thanks so much for breaking that down for us. Keep it right here on Yahoo Finance. Coming up, we'll discuss how investors should be positioning their portfolio ahead of Fed Chair Jay Powell's press conference or speech tomorrow at Jackson Hole. We've got that for you next when we come back. Stocks moving higher, not too far from those record highs as investors look ahead to Fed Chair Jay Powell's speech tomorrow. The big question for investors is whether or not that momentum can continue or whether or not we are due for a pullback. Here to discuss, we want to bring in Irene Tunkel, BCA's Research's Chief U.S. Equity Strategist. Irene, it's great to have you here on set with us. Let's talk about some of that return in momentum that we have seen within the market. Here we are this morning, not too far from those record highs. Is there reason to believe, or a reason at least to be concerned, that we could see a bit of a pullback here, and why?
Good morning. Well, I think it's a great question because that's exactly what everyone is thinking, because just as we expected a pullback, suddenly stocks staged a comeback. So the question is whether it's sustainable. I personally think that we are entering a period of heightened volatility because we almost have like a triple whammy of things. Mm-hmm. So let me think. So first of all, economic data is very mixed. So it's a pool between, bears and bulls, soft landing, hard landing. So it introduces lots of volatility. Second thing that is happening is the Fed is bound to, start easing cycle. But we don't know yet by how much. Mm-hmm. So that introduces some uncertainty. And the third thing is election. Mm. And I'm not even talking about geopolitical uncertainty. Mm-hmm. So we have three things that, if nothing else, introduce volatility in the market. Mm-hmm. And it appears to me that the market is very positive. It's priced for perfection. Perhaps the macroeconomic backdrop is fine. Mm-hmm. But let's think, there are so many things that are coming up, and stocks are expensive. So I would think that we will have quite a bit of volatility, a little bit up, a little bit down. It's very hard to see the market making new sustainable highs.
So for volatility then to be put to rest from your purview here, would it take us fully understanding, or the market fully acknowledging, or at least hearing from the Fed what their terminal rate on the cutting cycle would look like?
Yeah, I think the market is already expecting something like 2% down from where we are. So the Fed has to actually surprise and deliver much more, or at least hint that it will be very aggressive in rate cutting, because otherwise you might argue that all of that has been priced in, because the conversations about that have been happening for, weeks now. So we are still sort of trying to work out what is the trajectory, whether the Fed will be aggressive, or they will go 25 bips or 50 bips. But I think that if you think about the big picture, the rate cutting cycle is more or less priced in. So here again, you can have some negative surprises if the Fed comes across a little bit more cautious, if they utter something about how they need more confidence, or how they want to be patient, or maybe gradual and careful. I think the market may not like that.
Irene, even if we do get a cut in September, looking past tomorrow and looking ahead to next month, if it is a 25 basis point cut, to your point that much of that has already been priced in, is it likely that we will see a sell the news type of event right after that is announced? Or I guess, how should investors be thinking about that? Yeah, I've done some analysis. We at BCA have done some analysis. And what it shows is that buy the rumor, sell the news totally applies to rate cuts. The market usually, is getting very excited just before the rate cut, and just when it happens, for 3 months, you usually have a pullback. So historically, returns have been positive. The months of the first rate cut, only 30% of the time, which is very low. I think that the standard, average is 60% of all the months are positive for the S&P 500, and here you get 30. So I think it's an indication that people may be selling the news.
You mentioned November. We're just a couple of months away from the election. How should investors play the markets during that key event?
Well, I think that heightened volatility, whatever is the cause of that heightened volatility, usually warrant somewhat defensive positioning. So I would say that it's very hard to think about, defensives like boring pharma. All the pharma is going up. It's hard to think about consumer staples when you have such exciting, semis, which go up a lot. But I think that it's for prudent investors. First of all, of course, you still need diversification. And I would add defensives, just because when volatility goes up, it goes up quickly, as we've seen, a couple of weeks ago. And, returns accrue, fast and steady. Mm-hmm. So I think it's better to reduce volatility of your portfolio, add defensives. And also I think that next 3 months will be kind of difficult, just because there's so much news to go, coming through. After the election, if we do get, I think the best outcome would be if we have a divided Congress, we have split government, and we find out that there is no recession, so we perhaps have soft landing. Then stocks will stage an amazing, comeback. But until then, it will be lots of push and pull So I think that it's just prudent to be positioned, defensively.
Irene, what is your base case on whether or not we are going to see a recession? Are you confident in that soft landing narrative, or does that real risk to the downside remain?
Yeah, I'm a little bit skeptical about soft landing because if you think about it, soft landing is warm. Right. So it's intrinsically kind of a momentum state. If you go from hot to cold, you always pass warm. And you don't really stay there. Mm-hmm. The temperature keeps falling. And I think that although the data is somewhat mixed, there are multiple indications that the economy is actually cooling. Mm-hmm. And I think that what is, that standing question, how much will it cool? Right. So I think that the, bulls and optimists think that, economy will cool, but perhaps nothing terrible will happen. And people who have slightly more sort of extreme views think that, when unemployment rate starts to go up, and it already has started going up, it rarely stops. And also, rate cuts rarely preclude a recession. Mm-hmm. So by itself, it's not a panacea. Just like we were talking about long and variable lags when the Fed was hiking, I think there are still long and variable lags when they're easing. And when the Fed eased in 2007, we still proceeded to have a recession. Mm-hmm. So I think that what the Fed will do doesn't have an immediate effect on the trajectory of economic growth. But I think that, whatever the cycles in the economy, perhaps it will be a very shallow recession, but I do think that the economy is slowing.
So then did the Fed wait too long?
Well, there's always, it's very easy to criticize people who pretty much manage the economy. Everyone knows better what they are supposed to do. I think that they're trying very hard. There's certainly some concerns that, again, they have overstayed their welcome, just like they, were kind of dismissive of inflation before. I think they're trying their best. I'm not sure that they are late, simply because I think that the job market is slowing, but it is still fairly strong. Mm-hmm. And even we at BCA who think that we are moving towards a recession, we are not saying that we are in a recession right now. We are not saying that the job market is completely frozen. Mm-hmm. All we are saying is the trajectory is very unfavorable.
Yeah. A job that not too many people envy.
Yeah.
Considering the responsibility of it. Irene Tunkel, thank you so much for taking the time here with us in the studio. Irene Tunkel, BCA Research, U.S. Equity Strategist, U.S. Equity Strategy Chief Strategist. Thank you so much.
Thank you. Thank you, Brett.
We've got all your markets action straight ahead. Stay tuned. You're watching The Morning Brief. We're tracking shares of NVDA here today, higher by a little more than 1%. And this is about a week ahead of its highly anticipated earnings report out August 28th. That's near its record high of $135 back in June per share, with expectations remaining high. Will this report be the biggest catalyst for both the tech sector and even the major averages? For more, let's welcome in Mark Shmulik, who is the Bernstein Internet Equity Research Analyst. Mark, always a pleasure to speak with you and get some of your insights on this. All right, so August 28th, how much of a bellwether do we continue to expect Nvidia to be for some of the broader equities market right now? But additionally, who are the biggest winners perhaps to ride those coattails?
Yeah, it's good to be on again. And it's interesting. I get to cover many of NVIDIA's biggest customers and, Meta, Amazon, and Google. And clearly they've all come out in their earnings reports, not too long ago saying, look, the risk of underinvesting is much greater than the risk of overinvesting in this AI thematic. And so, all eyes will once again be on NVIDIA as kind of the bellwether of this Magnificent Seven and this AI trade. And, so long as that momentum continues, I think, my companies that I get to cover have earned the right to go after the opportunity, so long as core fundamentals remain strong. So I think, folks will be looking for weakness if there is any weakness, any softness. Maybe the entire Mag 7 rotation out may pick up a little bit of steam. But I think what investors have told us, listening into kind of the other tech earnings, is that core fundamentals keep delivering on that performance, and by all means go after the opportunity, and we'll deal with our ROI at another date.
So Mark, what does that tell us just about the AI trade, that momentum maybe that we are expected to see, given those positive comments that you are talking about? Because it did seem like we were seeing this shift in narrative, that just in terms of overextension, valuation concerns, obviously that has been shaken up just a bit over the past 2 weeks. But I guess, what is your view now of current valuations, specifically the ones that you do cover within the larger cap tech space, and then what that tells us just about further growth that we could ultimately see here over the next couple of quarters?
Yeah, certainly. I think the names we cover, not demanding valuations at all. I think as the dust has settled, you've got Google trading at more or less a market multiple, maybe a slight discount. I think there's a whole bunch of other reasons why that's the case. Meta's at a slight premium. Amazon's pulled back in a little bit as well. So I don't think the valuations are demanding. I think AI is part of the story, but again, what really matters is you have to deliver on the core business ahead of you today in order to continue to ramp up the investments that they've all, as a collective group, communicated that they will continue to go after and pursue. When we look at like the cloud players in particular, they're all calling out kind of continued ramp in AI related revenue contribution. We think for Google Cloud, it may be as high as 10% of revenues are now coming from, AI related or AI adjacencies. That's not an insignificant number anymore. And so it's no longer kind of talk of a theoretical. It's actually showing up in the numbers. And so long as that continues, I think there is incremental buying in the names. If it doesn't, if there is any kind of air pocket, I could certainly see, investors looking to take profits even at what I think are very reasonable valuations.
Mark, is there a sleeper winner right now when it comes to who's showing consumers that AI can be put in front of them right now, that there are solutions that can be at the fingertip even, and that's translating into real revenue and real profits?
Yeah, I'm not sure if it's a sleeper. I think it's kind of what I would call one of the cleaner names in internet these days is Meta. They've kind of shared that their plans are to be the most used consumer generative AI product by the end of the year, through Meta AI. I think one of the things that Mark Zuckerberg shared on the call I thought was fascinating was his framing, of it is, every business has their own website, they have their own store, they have their own app, and soon they're going to have their own, kind of personal generative AI agent. What does that mean, for not just the largest social media platform on the company, but also the largest messaging platform on the company, and how consumers are going to act not just with the generative AI personal assistants, but how we potentially interact with businesses going forward. I think that's all incremental. It's not kind of part in what's priced in at the moment. I don't know if I'd call it quite a sleeper, but as I kind of take a look at the highest probability of potential product market fit in the consumer Gen AI space, that's the name I'd circle that's got the resources and the channel to push a product like that to market.
Mark, let's talk about Netflix. It's trending on some of our watch lists here at Yahoo Finance, hitting a record high this week. Some encouraging commentary surrounding upfronts and exactly the growth that they're seeing there. I'm curious just how you view Netflix versus the rest of media, and given the fact that they have long been considered very much a leader within the space.
Yeah, I think that's probably one of the things most beneficial to the Netflix story right now is that what's happening in the rest of media is a little bit chaotic. And, they certainly seem like a nice kind of safe story that's very consistent around its message, delivering to kind of beat and raise on net subscriber additions. The data point that came out this week that kind of their advertising commits are up 150%. Versus what they did last year. Now, we don't have the exact numbers, but that growth certainly is trending in the right direction. And this comes just as they've kind of reset investor expectations about tempering, when we think advertising revenues are going to be incremental to the Netflix story. You then also still have the back and forth about what really is the health of the consumer and what kind of an environment are we entering. Companies like Netflix are now always on. This is the last media property you cut as a paying consumer. So there's a defensive element to it here as well. So you kind of take a look at all the different elements of what you'd want to kind of own Netflix, and certainly understandable why it's been tracking in the right direction recently.
Mark Shmulik, who is the Bernstein Internet Equity Research Analyst. Mark, always a pleasure to grab your time here and get some insights. Appreciate it.
Great. Thanks for having me.
Certainly. Hey everyone, right after the break, we're taking a look at what's trending on Yahoo Finance and breaking down why. Stick with us.
We're taking a closer look at some of the trending tickers here at Yahoo Finance. We've got Urban Outfitters, BJ's, Williams, Sonoma. A real good look at the retail sector, doing each in 30 seconds. Let's kick it off. Urban Outfitters shares are plunging today. You're looking at a drop of nearly 14%. The company's same-store sales in the second quarter missing the street's expectations. The company saying it may add promotions and markdowns because of the sales slowdown. So very similar to the cautious consumer commentary that we have been getting out from so many of the larger retail players over the last week or so. When you take a look at today's drop, you're looking at 13% move to the downside. It's the biggest intraday fall that we have seen since the end of February. So really putting that in perspective, this is enough for Telsey to downgrade the stock. They're talking about the fact that it's going to take some time in order for their improvements, in order for that turnaround to take place.
Yeah, absolutely. We're also watching shares of BJ's here, the wholesale company, and they're down by about 6.9%. The wholesale club's full year guidance slightly falling short of expectations, but its profit in reporting its second quarter beating estimates there. Taking a look at some of the growth in the net sales, at least that was up by about 4.4% over the 26-week period ending the beginning of August here. And I think going forward from here, the company really going to be focusing in on building out that membership growth, re-accelerating traffic and unit growth as well here is what they were saying they got. I almost made it.
Almost made it. All right, let's round it out with Williams-Sonoma, giving us once again the cautious consumer vibes within this report. You're looking at shares tumbling off just about 9%. Home goods retailer cutting its full year sales guidance. Its sales for the second quarter missing the street's expectations. Very similar story here to what I was just talking about a moment ago when it comes to Urban Outfitters. But here specifically for Williams-Sonoma, a bit of a different story given the fact, obviously, it's a home furnishings retailer company, so more tied maybe to the sluggishness that we have seen within the housing sector, given the fact that existing homes remain at very depressed levels. Also the fact that so many Americans simply can't afford to move right now, given interest rates and given mortgage rates and the high prices right now. Same-store sales did decline more than analysts had been expected. We'll get more commentary out from the earnings call. That's going to take place in just a few minutes. We'll keep right here on Yahoo Finance. Much more coming up. First up, we're going to get a glimpse into the health of the economy. We've got fresh manufacturing data out. What does this all mean for the soft landing narrative? And later, Democratic presidential candidate Kamala Harris will take the stage at the DNC tonight. What do economists and investors want to hear? We're going to discuss all that and more next. Just after 10 a.m. here in New York City, I'm Shauna Smith alongside Madison Mills. We got three catalysts moving markets today. The manufacturing data just coming out, really giving us a better idea of that soft landing narrative. And when it did come in slightly softer here, so again, some questions. Ultimately, what this means, we saw stocks pairing gains here as they do weigh, as investors do weigh the latest data that we are getting out. Maddie's going to have more on that in just a few moments. But again, this report coming ahead of Fed Chair Jay Powell's remarks at Jackson Hole, and Vice President Kamala Harris preparing to formally accept the DNC nomination for president tonight.
First up, though, that manufacturing data, we're going to talk about that because you are seeing some pressure on the services side of things with that PMI data, but it's signaling the manufacturing sector, rather, contracting at the fastest pace this year. That weakness is pressuring markets. The PMI data considered a forward-looking metric that tells us how purchasing managers are spending and indicate how folks are feeling about the broader economy. That data coming ahead of the defining moment for the economy's path forward and Fed Chair Jay Powell's highly anticipated speech at Jackson Hole on Friday. His remarks likely to be the biggest catalyst for markets of the week, eager to price in the central bank's rate cut plans.
Vice President Kamala Harris gearing up for her acceptance speech as the presidential nominee at the DNC. As Harris is focusing on economic policy, Democrats are pitching her as the pro-business candidate. That's despite her recent policy positions on price gouging and also what we're hearing about what she wants to do with the corporate tax rate. We will tell you what investors need to know and listen for in the DNC speech tonight. Well, manufacturing data coming in weaker than expected. Maddie, when you take a look at the stock reaction off the highs here of the morning, we're seeing some of that pairing those earlier gains, Maddie. But again, PMI obviously very critical and just the latest economic data point that we're getting ahead of Fed Chair Jay Powell tonight.
Yeah, I want to correct what I said earlier. So we are actually seeing strength in the services sector, which is in line with what we've been hearing about, right? Services spending has been driving inflation higher, and that has been a key issue for the Federal Reserve. But manufacturing was as slow as it has been in years, and that is going to be critical to watch. That's why you initially saw the market under a bit of pressure off this PMI data. But as always, the market looking at the good news being good news in the print. Softness could be a sign of rate cuts to come, and that is why you are seeing stocks continuing their moves to the upside here. You've got the Nasdaq up 0.3% and the S&P 500 up 0.2% here.
All right, Maddie, let's also take a look at that existing home sales numbers that we are getting out here at the top of the hour. It actually rose 1.3% in July, essentially in line with expectations here. And it is a reversal, and this is important to note, from what we actually saw the prior month, because it had fallen 5.1% the prior month. So why are we seeing more activity? Some of that having to do with the lower mortgage rates, obviously, that we have seen, increasing homes, obviously luring some of the buyers back into the market. So much of this very much hinging on pricing and what we see further here for the 30-year U.S. mortgage rate going forward. But again, existing home sales at least rising for the month of July, up 1.3%, essentially in line with expectations, Maddie.
All right, well, we're going to get to that PMI data again, signaling the manufacturing sector contracting at the fastest pace this year. Strength in the services side of things, as I mentioned, stocks initially dropping on the heels of that data, but now recovering and moving further to the upside. All week, we've been talking to guests across our shows about the state of the macro economy, and here's where they stand.
I think we're looking at continued steady growth as the economy proves resilient, stays out of recession, and the labor market stabilizes.
I think the jobs report on Friday was certainly not helpful to what was going on, but I'm not in the camp that this is screaming recession.
I think it is clear that the economy is getting softer and earnings presumably will get somewhat softer with it.
All right, here to weigh in with more, we got Chris Williamson. He is Chief Business Economist at S&P Global Market Intelligence. Chris, great to have you on here. So talk to me about the single biggest takeaway that you have from the totality of the data this morning. We saw some areas of strength, some areas of weakness. What's the thesis here?
Yeah, so the big takeaway here is really that you've got sustained growth into August. So the third quarter's looking like it's going to be another reasonable period of GDP expansion. At the same time, the underlying inflationary pressures are further cooling. So this is all soft landing scenario stuff. But as soon as you scratch beneath the surface of that, there are some worrying signals. And this is where the markets were getting worried, in particular that manufacturing sector seems to be slipping deeper into contraction, leaving the economy very dependent on the service sector for its growth. So that's a key area of concern. Will that manufacturing downturn spill over to services and lead to a deeper downturn later this year across a broader swathe of the economy?
Chris, what's your base case? Do you expect that to happen?
No, quite simply because we should see some interest rate cuts, which should stimulate demand further. So it should arrest that downturn, exactly what they're supposed to do. We're getting these warning shots that things are not all good in manufacturing. The current situation is likely to worsen there in the near term. Look at the orders inventory ratio in manufacturing. It's one of the lowest levels that we've seen since the global financial crisis. There's not enough orders coming in and stocks accumulating, unsold stock. So manufacturers are struggling. The service sector is still doing well. Now, if you get some rate cuts, they're going to support that service sector and stop that spillover. So that's our base scenario, really, that you're going to have this domestic strength in the US economy. Manufacturing is a small part of the economy. It's only around 10%. If you can keep that bigger chunk of the economy going, the service economy, which is much more receptive to interest rates and much more dependent on domestic demand and the labor market in particular, you should get this recovery sustaining into the second half of the year quite nicely.
Since you mentioned the labor market, I'm curious your take on the revisions data that we got yesterday, obviously coming in at the higher side of revisions, a decline of over 800,000 jobs over the course of the year here. Where are you getting clarity on the strength of the labor market in today's data? What is it telling you?
Yeah, well, I think those revisions bring the data a bit more into line with some of the other data on the labour market, including our own PMI numbers. But even these have been showing some weakness. So over the last 5 months, we've had a number of periods of companies cutting back on their staffing levels. So there's a definite sign of the employment growth contracting. But there again, it's complicated here because depending on which sector, there's different reasons for the fall in employment. So in manufacturing, you're getting hesitancies hiring because of uncertainty about the outlook. But in the service sector, which is growing strongly in terms of output, employment's actually falling. And that's because companies just can't find the staff. So you've got two very different economies, really. The manufacturing one, weakness and shedding staff in some cases. The services economy growing so fast it can't find the workers. Clearly, policymakers aren't going to like that scenario if it spills through to wage growth. But at the moment, it does look like those wage pressures are contained because headline inflation's coming down and the wage negotiating power's cooling.
Chris, does it at all change the urgency here of rate cuts, just in terms of how large that first rate cut should be, or maybe the pace is the better question there after we do get whatever cut ends up being, or if we do get a cut in September, what then that pace should look like going forward?
Yeah, well, so our view was the markets had got ahead of themselves a bit, and they possibly still are with the number of cuts they're pricing in. It's certainly looking like September's pretty much a done deal now, providing we don't get any surprises with the next lot of inflation data. And the numbers that we've got today, these numbers really play into that hand that you should get a 25 basis point cut based if you're just looking at these numbers today. That softening of service sector input cost inflation, despite those labour market conditions, it's a nice picture of contained wage negotiating power feeding through to lower inflation. So I think with that and those cracks that are appearing, certainly the weakness in demand that might worry some policymakers, look like they might persuade them that let's move now, but let's move in an orderly fashion. Let's cut rates gradually. Let's not spook anyone by doing a 50 basis point cut that people might worry that they know something that we don't. It knows the economy really starting to struggle. It's not. It's a soft landing scenario still, and that should be that landing should be supported by just some modest action on those rate cuts.
All right, Chris Williamson, always great to have you. Thank you so much for your insight, especially to this breaking data that we're just getting out this morning. Chief Business Economist at S&P Global Market Intelligence. Thanks again. In less than 24 hours, Fed Chair Jay Powell is going to be taking the podium at the central bank's annual conference in Jackson Hole, Wyoming tomorrow. Now, Powell remaining a key catalyst potentially for the markets, and what he says could really send shockwaves for stocks depending on what he says. Now, for more on what to expect from that speech, we want to get to our Fed correspondent, Jennifer Schomburger, joining us live from Jackson Hole. Jennifer.
Good morning, Shauna, live here from Jackson Hole. Indeed, all eyes will be on what language Fed Chair Powell could use in his big speech slated for Friday morning. If the Fed minutes released yesterday were any indication, Powell could take things further. In the Fed minutes released on Wednesday, they said that, quote, the vast majority thought that if data continued to come in as expected, it would be appropriate to ease policy next meeting. Given that strong language used in the minutes, which are now 3 weeks old, and that inflation has continued its downward trajectory, just as the job market continues to cool, Powell could strike a stronger tenor for September while still leaving some wiggle room. Look for anything around gaining greater confidence. Benson Durham over at Piper Sandler saying that Powell could implicitly update the FOMC statement with language along the lines that the committee is gaining greater confidence that inflation is heading towards 2%, tweaking that key language in the statement from January that, quote, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. Now, the minutes said that recent data had, quote, increased confidence inflation is moving sustainably back towards 2%. So again, looking for any clues on that from Chair Powell. Also, look for anything that the Fed chair says around the job market. Officials now looking at risks to both sides of their dual mandate as equally weighted. And given the cooling that we've seen in the job market, that is very much factoring into September's decision. Back to you.
Certainly, Jennifer. And we also know from the Fed's Patrick Harker this morning also saying that if the data comes in as expected, a September cut could certainly be on the table. So we'll be monitoring all of the Fed speak. And I know you'll be bringing us more reporting from Jackson Hole. Thanks so much for being here with us this morning.
Yeah, and it's really just a difference between 50 and 25 at this point. And I think that if it's going to be 50, it's going to be because we have a weaker jobs report for the month of August. And just by the way, anecdotally, I ran into Fed Chair Powell in the lobby yesterday, and I said, are you ready for your big speech on Friday? And he says, oh, I'm not giving a speech this year. Jokingly, of course.
Jokingly, of course, but we
always
really
keeping it real here at Jackson Hole.
We're really relying on that speech at the top of our show tomorrow, Jennifer. So let's pray he was joking.
Oh, of course.
Thank you so
he's
much.
Going to give it. He's going to give it.
Thank you, Jennifer, for joining us, and of course, we'll be chatting with you tomorrow as well. Well, Vice President Kamala Harris is set to take the stage tonight at the Democratic National Convention. Harris is expected to formally accept the party's nomination for president and also to discuss her economic policy agenda. This comes as Democrats are pitching Harris as the candidate that is pro-business. So for more on that, let's bring in Yahoo Finance Washington correspondent Ben Merschel. Ben, thanks so much for being here. I hope our audience kind of prepare for the remarks they're going to be getting tonight from a business and investor perspective. What should investors be listening in for?
Yeah, the speech tonight is going to be a big moment in the campaign, one of the biggest so far. And what Harris aides have already laid out is that she's got to do a lot of things for a lot of audience. She's got to sketch out her biography. She's got to draw a contrast with Trump, both on tone and on policy. And then finally, I think an uber goal of these speeches is to kind of make America comfortable with the idea of her as a president and her as somebody that can be a shepherd of the whole country. And I think that last one is, to answer your question, where we're going to see a message to the business community and to investors. You know, this idea of Harris being a shepherd of the economy, somebody that kind of represents stability in contrast to Trump is a theme we've seen under the radar all week here, or over the week in Chicago, and we've seen at the convention. So I think we're going to see more of that. But to sort of level set, the top message here is going to be to middle class swing voters, and that's a message on housing prices, grocery prices, less popular perhaps with economists and business leaders, but that's where the focus we're going to be. One thing we're not going to hear, and Harris has already said this, is policy. We're not expecting new policy to be unveiled tonight. She's going to talk about the cost of living plan she unveiled last week. She's going to talk about things she's already talked about, but we're not expecting a lot new on her front.
But I'm curious what you make about the fact that it does seem to be, I mean, both conventions really light on policy, not remaining vague just in terms of what their plans are. From the sources that you've been talking to, I guess, are they viewing that as a smart strategy? Is this a missed opportunity? What do you think?
I think they think of it as a smart strategy. I think they, to go back to the grocery prices, policy she unveiled. That's been pretty unpopular. It's been slammed, but it's at the same time, it can be popular if your headline is that she's going to ban price gouging at the grocery store. So I think being vague can't have its advantages and disadvantages. So, and that's what we've seen of both, is sort of broader promises, and at least on Harris's front, more planning to be unveiled in the week ahead. We're going to hear more from her on childcare. We're going to hear more from her on long-term care. But for right now, they're kind of doling it out slowly.
All right, Ben Werschel, always great to have you. Thanks so much for your reporting. And of course, we're looking forward to hopefully talking to you after Kamala's speech tonight. Well, coming up, Yahoo Finance Executive Editor Brian Sazi. He will be live with Gap CEO Richard Dixon. That comes from the floor of the New York Stock Exchange. We're to get some insight into the health of the consumer. We're looking at a live look of Sazi right now. We'll be right back in just a few minutes.
Welcome back to Yahoo Finance. Now, if you're on the Yahoo Finance platform and search for Gap on the platform, something might look a little different. That is, they have a new stock symbol. Let's break all that down and what Gap is up to with Gap CEO Richard Dixon. Richard, good to see you as always. So look, I mean, this has been, GPS was the stock ticker for as long as I've known Gap was. Since 1976, the company went public. Take us through the decision, because you still have family members of the founders on this board. So this isn't like, I want to switch the stock ticker and let's just get it done.
Yeah, well, it's a great question. We do have the Fisher family, who's still very much connected to the heritage of the company, both present and also future. And it was to some extent an obvious conversation. I mean, GPS or GAP, right? I mean, so there is, to some extent, one of those moments where you go like, well, why not?
Why was it GPS?
It was actually, that was a good question when we asked, like, what if we change it to GAP? The question of what does GPS stand for was one that we had a few minutes to try and figure out. It was actually Gap stores. And today, you know, we're a portfolio of iconic American brands that shape culture. Started with, of course, the iconic Gap brand. So there's no better, more milestone moment than our 55th to declare it with pride and say, you know what, our ticker is Gap. And so there's a lot of energy behind it. It is obvious, and we couldn't be more excited about it.
Well, there's also two dates of significance. On this day, the first Gap store opened in San Francisco
August
as well.
22nd, right.
How are you playing into the company's heritage, but trying to finally move Gap into an era of coolness where it hasn't been prior to when you took over?
Yeah. Well, as you note, August 22nd, 1969 was the first Gap store in the heart of San Francisco. It was 55 years ago. It was also 1 year ago today that I started as the CEO of Gap.
Come on, man.
I took it away, but it was a symbolic start date for me to really recognize the heritage of the company. It is an extraordinary company with legacy moments, and many of our moments define culture, whether we introduced Casual Fridays and now Everyday Casual, to the extent that we've been defining American fashion and culture with our portfolio is a recognition of the power of the portfolio. Now, we've gone through peaks and pits and ups and downs, and in the context of where we are now, as you know, Brian, we've spent a lot of time driving our strategic priorities, bringing back financial and operational rigor, enabling us to reinvigorate these brands to the extent that we could revitalize them and be part of the cultural conversation. Great product, great price, great storytelling, great store experiences. These are all fundamentals that we're working really hard to fix. And the last, but certainly not least, is really energizing our culture. Gap has always been about extraordinary people. There's been legendary talent that has been part of our blueprint that got us here. And it's still very much ingrained in our culture that it is really all about our people.
Early on in your tenure at Gap, Richard, we had coffee at the New York City office, and you did what any new leader does when they get into a company. I mean, they're questioning the people in the room, thinking about what a company may execute on over the next few months. But now that you're a year in, what is the next 2 to 3 years? How will you define that, and how will it look different compared to your first year at the helm, where you were fixing a lot of things that didn't even work right? I mean, the website was just not good.
Yeah. Look, we admit there were a lot of challenges, and ultimately, where we've sort of sequentially created our path for transformation is really short, mid, and long-term objectives. In the short term, we are concentrating on fixing the fundamentals. You know this, retail is detail, and every moment matters, every interaction with our consumers. We've got to have the right price, the right product, the right assortment at the right time. That is not easy to the scale that Gap operates. And so really digging in with financial and operational rigor, putting the company back on solid financial footing, running leaner inventories, less discounting, expanding gross margin, controlling the controllables. These are all the mechanics of running a better business. Now, once we get that right, and we're starting to prove that you can rely on us to say we're going to do what we say we're going to do, we have a playbook to reinvigorate our brands. These are brands that are well-known, iconic American brands that shape culture. They have a strong position with consumers that resonates. We just have to dial up our storytelling, dial up fashion, make sure the basics are always there, create compelling experiences both online and offline, and we've got a bright future to go and create.
I was scrolling LinkedIn, I was talking to you, and there was this video of your Athleta brand, like it was goats walking around the Athleta, I guess it was headquarters or office. I'm like, what the hell is that? I mean, it's just wild. But I think that has always been your secret sauce, that marketing component. How will Gap show up for marketing this holiday season? I remember when I covered Gap as an analyst, how the company marketed during the holidays was always like a hot discussion. Yeah. Are you ready to say, you know what, we got these brands where they need to be, and we're all in this holiday season?
Yeah, look, marketing is a complex subject. When you break it all down today, it's obviously very different than it was 55 years ago. It was different than it was a year ago. The key to really effective marketing is being where your consumer is. And that means you need to be everywhere in some way, shape, or form. You need to create assets that are compelling, intriguing, that break through. You need to give creative freedom and the empowerment to narrate with a strong brand position that creates assets that engage people all around the world around your brand. And the Athleta recent post with the goats is a perfect example of creative. Come on, they're definitely goats. Simone Biles, Katie Ledecky, honoring them as ambassadors for the Athleta brand with a really clever way of personifying it is indicative of the new creative spirit that is part of Gap Inc. You can see it in all our brands. Gap brand today launched the Get Loose campaign, which is really declaring a trend of baggy and loose fit, where Gap has always been synonymous with trends and taking basics and personifying them. Fashion is entertainment, so many of our brands are starting to really curate and be part of the cultural conversation. And ultimately, that is where brands need to be, part of the cultural conversation. And you need to move at the speed of culture, which means you're not always going to get it right, but you need to continuously swing.
We're getting a lot of weird reads on the consumer, Richard. So 2 weeks ago, Walmart CFO told us that consumers buying apparel. Good. Target CEO told me this week, consumers are buying apparel. What's your vibe and read on the consumer, as we enter the critical back half of the year?
Yeah, look, we're seeing similar dynamics in consumer behavior for the last year that was similar to last year. We are all working against a backdrop of macroeconomic uncertainty. We're all coming up with, political unrest in the context of an election that's about to happen. There's all sorts of dynamics that we're all navigating. So I think it's the right tone to be cautious in the context of where the consumers are navigating with all the various different dynamics that we're all dealing with. That being said, there's always winners in every space. We're really proud of the work that we're doing. As we know, we're in a quiet period right now, but we've been gaining momentum, we've been gaining share, we've been dialing up categories where we believe we have a leadership persona and personification. As we continue to reinvigorate these brands, we're going to see a lot more momentum. And so, again, I think the consumer, as they migrate a little bit more towards value, that really speaks to a welcome mat for Old Navy. I mean, we are the style authority in the value space in apparel. So we've got a great portfolio, arguably good, better, best in the context of our three, and then Athleta is really serving that performance, athletic, active gear consumer. And so we couldn't be more excited about our positioning, where the consumer is, and where we're there to meet them.
I'm not as tall as you, Richard, but I look good in these loose Gap jeans. I mean, you can tell me if I would look terrible.
Brian,
it's fine.
you look great every day, and that better be banana head to toe. But I can get you into a pair of new loose jeans, and you will be hip as
y'all would say, no comment. Richard Dixon, good to see you, Gap CEO. Be well, we'll talk to you soon. Shauna, back to you. Get some loose-fitting jeans.
I will. They're in style. And I was going to say, not every day that you see jeans on the floor of the New York Stock Exchange. Brian Zazzi, great interview there with Gap's CEO. Thanks so much. Well, the battle for Paramount continuing as Edward Bronfman Jr. submitting a revised offer to take over the company. Now, this coming after Paramount already accepted an offer from David Ellison's Skydance Media. You're seeing some gains in Paramount stock here today. Not much movement, though, up just about 0.2%. Senior reporter Alexandra Canal joining us now with the details on that latest offer. Allie.
Hey, Shauna. Yes, we have a new bid from Bronfman as Paramount Special Committee Board officially extended the go shop period by another 15 days as they assess this new offer. According to the Wall Street Journal, Bronfman has sweetened his bid to $6 billion for National Amusements. National Amusements is the holding company that controls Paramount and is operated by the Redstone family. Now, Bronfman's bid reportedly includes a $1.7 billion tender offer that would give non-voting Paramount shareholders an option to cash out at a premium of $16 a share. Now, to compare deals here, David Ellison's roughly $8 billion offer would merge his company, Skydance Media, with Paramount. It also includes $4 billion to purchase about 50% of Paramount's non-voting shares at $15 a pop, or investors can choose to roll them into the new company. So at this point, it's really up to the special committee to determine if Bronfman's bid is superior to the bid that they've already accepted from Skydance. Now, Wall Street analysts have said this is all a bit confusing at this point, but someone in the Redstone family might be more interested in this new 11th hour bid than initially thought. So does it have weight? Maybe. We do know that Skydance has a plan in place for the company that includes cost cuts and a strategy revamp. But remember that this has not been an easy journey. Shari Redstone, she initially called off the Skydance deal back in June. There's also been concerns of lawsuits due to shareholder dilution, which wouldn't be as much of an issue with the Bronfman deal. So lots of twists and turns here. It's clear anything can happen at this point. Paramount shares, as you were saying, they were up as much as 2% in pre-market trading, but they've since given up some of those gains. So the hope here, at least from the investor standpoint, is that a bidding war will ultimately be a good thing for shareholders, but we'll just have to wait and see.
All right, we'll have to wait and see. But another story we got to get your take on, Allie, before we let you go. Disney also out with an update on succession planning. What can you tell us?
Yeah, so James Gorman, the former CEO of Morgan Stanley, he's going to be leading the succession committee at Disney. Gorman did lead a successful succession process at Morgan Stanley before he joined the Disney board earlier this year. So it's really not surprising that he was tapped for this role, especially since the stakes, they couldn't be higher this time around. We had the Bob Chapek disaster after Iger left the company. So the board really wants to avoid that. They want to get this right. Internal candidates like Josh D'Amaro, Dana Walden, they've been floated as possible successors to Bob Iger. We'll see who ultimately is tapped for this job, which we should know or at least have a more clear idea about by next year. So another wait and see story in the media world.
All right, Allie, thank you so much as always for bringing us your reporting on that. Appreciate it. Well, shares of Charles Schwab under pressure after TD Bank raised $2.5 billion in pricing the sale of over 40 million shares in Schwab. You can see that Charles Schwab shares are down about 0.3% right now, but they were down nearly 3% when we were closer to the market open. And just to give some context here, why is TD Bank doing this? Well, it's to offset fines that it is likely to face from U.S. regulators that is related to anti-money laundering penalties. TD, based in Canada, is preparing for that regulatory pressure, and that is going to be costly to them. So they are selling their shares in Charles Schwab. Obviously, bad news for Schwab. You can see those shares under pressure, and TD is one of the larger shareholders of Schwab here. So a difficult moment for Schwab this morning as the brokerage kind of cuts its ownership in those shares as well.
And I think more broadly speaking, there has been some questions, not so much specifically these two banks, but also just overall the health of so many of these regionals right now. And you also take into account the macroeconomic environment right now. If we do see a slowdown, there's so much uncertainty ahead. And we've talked to so many strategists over the last several months talking about the fact that we could actually see real movement in either direction for regionals going forward. Much of that very dependent on what happens with the economy. So I think that's adding to some of that trepidation, maybe just in terms of the street's reaction to all this. But again, TD, at least for this part of the news, taking the $2.6 billion hit on the U.S. Pro. So obviously, any sort of fine or any sort of, I guess, cost measures coming at a time like this just further complicates the overall investment story there.
Yeah, and a really great point on the regional banking pressure as well. That's a key part of the story, too. All right, well, we're going to have all of your markets action ahead, so stay tuned for more. You're watching Catalysts.
Snowflake shares are selling off here this morning, off just about 12%. That move to the downside is the biggest drop that we have seen, intraday drop since February. Now the move lower coming as investors do continue to worry about Snowflake falling behind on AI competition. For more, we want to bring in Brent Thill. He's Jefferies' senior analyst. Brent, you currently have a buy rating on the stock, and I was going through your brief reaction to these results, and you said that actually the results were solid, yet we are still looking at this move, the significant move to the downside. So Brent, what's the street missing?
They're in an investment year, and they have a new CEO. Sridhar came in, he ran one of Google's biggest businesses, and they're pivoting from effectively a one focused platform to multiple products inside that platform. And it's going to take time. So Sridhar is putting a new level of innovation. That's going to take time. The margins are way down this year as they're investing in AI. And then I think the third element is the magnitude of the beat this quarter wasn't as great as in the past quarters. But if you look at the future indications of health of the company are basically backlog signings. So the backlog was up high 40%. It accelerated. That's again, the future indication of health. So if the RPO numbers going higher, reported backlogs going higher, that means reported revenue should track that number over time. So I think going forward, this was a big transition year. 24 is, as we call it, a pit stop. They're getting the bugs off the windshield. They're putting new tires on. They're changing the carburetor in the car. And we think that they're positioned for a much better 25 and 26. For long-term shareholders, I think it's a great buy. The company has a buyback. I wouldn't be surprised to see them accelerate the buyback. We think there's nothing wrong when you look at the growth. The short term, they're on the side of the road. It's a pit stop. But they've got the right leader. They've got the right strategy. I think the product line is going to only blossom as we go into next year. And there's one major competitor. It's Databricks. They're private.
Right.
Databricks is doing way better in AI than they are right now. But we think Snowflake will catch up, and it's not a one-horse race. There's a couple horses that are going to be able to do very well in this move towards data.
So let's talk about the AI of it all. How do you model the health of Snowflake's AI investment, particularly in the context of a market that has been rebuffing AI spend this earnings cycle that's not seen as particularly useful or beneficial?
You're not going to see any of the software companies benefit from AI this year because they're all buying Nvidia, right? So as we've said, own infrastructure in AI this year for 24, not software, because the software companies, whether it's Amazon, Google, Microsoft, right? They're all software stories. They're investing in these AI platforms. None of these services are young. They're in their infancy. And so when you think about what Snowflake is doing, it's basically the same thing. Now, they're taking a bigger margin hit than others. Microsoft's showing higher margins. Snowflake's margins are going the wrong way. So, that is a very true statement. Like, is this going to work? Are they efficient? But we think it's the right move. When you think about, the companies that are betting on them, Disney, DoorDash, I mean, these are big investments in Snowflake, and they're holding all the data. Well, what do you need for AI? You need the data. And so we believe, again, underneath the leadership of Sridhar, that he will do the right thing for the platform. He will get in the AI game. They were very visible a year ago. They were nowhere in AI. They're in a much better spot. They're not where they need to be. No one in software is. I mean, it's a rounding error for every one of our software companies. So, AI is the story of infrastructure. 25 and 26 are the year of software in AI. And so it's super, super early. And that's what you're betting on. Can Sridhar fix this? There was this guy named Satya Nadella at Microsoft that fixed the server business a bajillion years back. They had a virtualization problem, a database problem. They had a cloud problem. He fixed it. Stock was 30. He's the CEO of the company now. So I just look at this and say, is there an opportunity? What are the other analogies? The other analogies in our industry is what Nadella did to the server business at Microsoft. And that worked out really well. So I'm not saying that Sridhar is going to be what Nadella was for Microsoft, but I'm betting based on some of the other metrics we're seeing that that should be beneficial for the company.
So, Brent, where does that leave then the valuation question? Because I feel like specifically, I mean, you can make this argument or you can bring up this question with a handful of AI names, but more specifically when it comes to Snowflake, is that a risk to the story at this point, and why or why not?
It's the biggest risk. It's the biggest risk. I mean, stock's always been expensive. I mean, back in COVID, it went to 50 times revenue, and it went from 50 times down to low teens, and now it's, again, we've said the support level will be 7-8 times forward, and that'll put you anywhere, between 90 and, call it 110. So you still have downside tactically short term because of multiple. And that's our biggest concern, which is software's been under duress. It's been an awful year to be a software analyst. As I've said many times, you want to be a semi and hardware analyst this year because that's where all AI is, all the spend's in there. It's not in software. I mean, I'm literally just sitting on the side of the road watching all the fun things go by, and I'm not part of it. So, but it will come to our group. And the point is, like, I'm not, and I've said this, a lot of our clients are short the stock, a lot of our clients are long the stock. The shorts are winning right now because tactically there is no catalyst. It's going to take another 6 to 9 months, maybe a year for this to play out. But if you're a longer term shareholder and you start to look at what is the world going to look like in AI? Does data matter? And if there's only two big data platforms, which is Snowflake and Databricks, which is private, do you think the market for data can support two companies or one?
Brent,
I mean, it's pretty obvious.
Brent, that comment that you just made, that it's going to take 6 to 9 months, I believe, in order for this catalyst to really come to fruition for these names. Is that a Snowflake-specific issue, or it sounds like maybe that's more broadly within the software space that you cover?
The entire industry. Yeah. I mean, Microsoft told you a year ago that AI would be the fastest business to $10 billion. They haven't said peep about hitting that target. Microsoft's going to be a $250+ billion company. That means it's a low single digit % of their total revenue. Amazon, they don't even break out the number. Google, how's the AI product going? Well, there's no financial impact right now. So Salesforce, they're not selling AI. Adobe, it's tiny. I mean, go through Oracle, it's tiny. It's tiny for everyone. It's not like this is Snowflake's losing and everyone else is winning. No one's winning in software and AI because it's so early. There's no revenue. But there will be. And so the point is, do you want to invest? Do you believe in that curve? Is it coming? Is it like what happened in the 90s with the internet? Do you believe it's coming or not? Some believe no, some believe yes. I believe I'm not on the most bullish end of that, but I do think it's going to be beneficial and it'll help. But remember, AI is one part of the Snowflake story. Disney and DoorDash, which my kids are addicted to and run my credit card up every month, literally on DoorDash, I mean, they probably make really intelligent decisions on what they do and how they target, what they set prices and where they put people and what restaurants they bring to the platform. I would assume they're using Snowflake to do that. Do you need AI to do that? No. But Snowflake is getting multi-$100 million plus accounts without AI. Right. So I think it just underscores, forget AI, take AI out of the conversation. Is this an important platform to help run companies and make better data decisions? The answer is yes. We at Jefferies use Snowflake. We're exporting our Salesforce.com data into Snowflake to make better customer decisions. So again, I think, right now, the bears are in camp. They're chewing through the garbage bins and the camp looks awful and no one wants to be there. And usually that's the time to buy. So I like it on this pullback. I think the leading indicator of health and RPO, which is their backlog growth, accelerated. That tells you they're signing more contract growth's accelerating. And there's only one way that revenue can go. It goes up because you can't have good backlog and low revenue. We learned that from Amazon last year. High backlog growth, low revenue.
Right.
Amazon's accelerating revenue growth this year.
All right, Brent. Well, great insights as always. Thanks so much for joining us this morning. And of course, we'll continue to have you on as software recovers over the next 6 to 9 months. So don't hesitate to get back on with us. Brent Thill, Jefferies senior analyst, talking all things Snowflake. We're going to do a quick check of the markets here. You're looking at a market that has sort of flipped back to the downside, but the S&P is around the flat line, the Nasdaq barely down 0.1%, and this comes as the market is sort of digesting the totality of the data that we got in this morning. There was a piece of the PMI data that showed a little bit of weakness in hiring, so that could be one of the driving factors. We also had that housing data coming in, traders sort of contending with data showing that U.S. sales of previously owned homes in the month of July rose for the first time in 5 months. So that could be an indication that the housing market is set to stabilize ahead of rate declines. That could also be potentially something that traders are digesting this morning, or just a wait and see approach before Powell's remarks set for tomorrow morning. We'll cover all that and more as we continue our show here, so stick with us on Catalysts.
Target, or what some have nicknamed Target, has seen its fair share of ups and downs in retail as a 6-decade-old company. Beyond the Ticker takes a deep dive into the retail giant's biggest moments. The first Target discount store opened in 1962 in Roseville, Minnesota. It was owned by the Dating Company, which also had a well-known department chain store called Dating's, but the two stores were competitors. Fast forward to 1990, the first Target Greatland opened in Apple Valley, Minnesota. 50% larger than a standard Target store, Target Greatland included wider aisles, additional food options, and more efficient checkout lanes. 5 years later, the first Super Target opened in Omaha, Nebraska, combining Target Greenland with an upscale grocery store, Archer Farms Market. Believe it or not, it wasn't until 2000 that Dayton Hudson Corporation was actually renamed to Target, operating under the new ticker symbol TGT. In 2014, current CEO Brian Cornell took the helm, faced with years of weak sales growth and in charge of turning the cheap and chic retailer around. Then in 2021, Ulta Beauty debuted at Target, proving to be a bright spot, luring in foot traffic as customers pulled back on spending in recent quarters. In 2022, Target was one of the first companies to address shrink, aka retail theft. That year, the company blamed the drop in gross margin rate on shoplifting or shrink. Now the big box retailer is thinking to the future, investing in promotions with its Circle Rewards program and investing in its footprint. With its biggest fleet yet, at the end of 2023, the company had more than 1,900 stores across all 50 states.
Kamala Harris understands that government must work in partnership with the business community.
Since the end of the Cold War in 1989, America has created about 51 million new jobs. What's the score? Democrats 50, Republicans 1.
If you're a middle-class family or a family trying to get into the middle class, Kamala Harris is going to cut your taxes. If you're getting squeezed by prescription drug prices, Kamala Harris is going to take on Big Pharma.
You just heard from former American Express CEO, former President Bill Clinton, and of course, Vice Presidential nominee Tim Walz laying out the Democratic Party's economic messaging this week at the DNC in Chicago. But is that message getting through to undecided voters concerned about the economy? Joining us now from Chicago, we've got Patrick Murphy. He's a former U.S. Congressman and the 32nd Undersecretary of the Army. Thank you so much for joining us here. So glad that we could get you on. So talk to me about the messaging that you are hearing, particularly from your former roommate running for vice president here, and the extent to which you think that that is resonating with voters.
Listen, I think it's right now across the country, and especially in the 6 swing states like Pennsylvania, my home state, it's a jump ball and it's 50-50. And so letting the American people know that it's about growing out our middle class from the middle out, not just from the top down, which has not worked. Those failed policies haven't worked in the 4 years under Donald Trump. They will continue to work if we give this ticket a chance, and that is Kamala Harris and Tim Walz. as you mentioned, when you have people like President Bill Clinton walk the American people through that the Democrats put up 50 million jobs, the Republicans only 1 million over the last 20 some years, that's a pretty compelling stat, especially when you look at how our economy, our unemployment is at a historic low right now in America. The stock market is at a historic high. There's a lot of good things happening, but a lot more work to do.
So I think the question is, when you talk about a lot more work to do, is what is needed to win over that independent voter. We certainly have seen strong messaging, much of that, though, obviously targeted or is really being heard, maybe is a better way to say that, by the Democratic base this week. How do you then expand that messaging in order to attract more of those independent voters?
Yeah, well, listen, part of it is having a conversation. You meet people where they are. And I thought that's what was so compelling about Tim Walz's speech last night. He's saying, this is going to be inch by inch, yard by yard. He's a former football coach, high school football coach that won a state championship after serving for 24 years in our Army. But that's what it's going to take to really convince folks who are undecided, the majority of Americans that will decide this race in those 6 swing states, like in my home state of Pennsylvania, will be the phone calls, the door knocking, the voter by voter that we need to do to win this race in 75 days.
Congressman, I've got a little bit of a weird one here, but just stick with me. So I know that you were Waltz's roommate back in college, and if you're anything like me and my former roommates from college, we were constantly talking about our financial concerns. Do you have any memories of the economic outlook from Waltz that you have from your time in college together that you could share with our audience?
Yep. So we were actually roommates in Congress. So we both won in 2006, and we were going through orientation, and we were looking for the cheapest apartment in D.C. that was in walking distance because we didn't have a car in D.C. And his family's back in Minnesota, mine was back home in Pennsylvania. Of the 435 members of Congress, Tim Walz and I think were the 10 least wealthy members of Congress, right? Because he was in public service as a school teacher in the Army, and I was in the Army. So we both had great credit, but we both had mortgages and we both had debt, right? And I think that's one of the plan moving forward is when you look at the American people, most middle-class families, their number one asset is actually their home. So how do you allow home ownership to happen? And their plan moving forward is really allow more Americans to get in that stock market to make sure when we have this, the Fed is going to cut rates in September. So even mortgage rates are going to go down, thank goodness, right? So that's a positive thing. But it's really, though, that focus, like a bulldog on a bone of what Tim has done in Minnesota that we have to basically do across the country. He's cut taxes for the middle-class families in Minnesota. Minnesota's 5th in job creation and their lowest unemployment in the whole nation. So modeling what has been working there to basically the federal level is something that we need to do with the Kamala Harris and Tim Walz ticket.
Great insight there on Tim Walz. Patrick Murphy, we always appreciate your time. Thanks so much for joining us here again this morning on Catalyst, former U.S. Congressman and 32nd Undersecretary of the Army. Thanks so much.
Thanks, guys.
All right, keep right here on Yahoo Finance. Coming up next, it's Wells, dedicated to all of your personal finance needs. Brad Smith, he'll lead you for the next hour. Stay tuned. We'll see you tomorrow.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, Fed officials, they're gathering in Jackson Hole, Wyoming for the central bank's annual economic symposium. Wall Street looking for any clues about the Fed's thinking around rate cuts. We'll talk to a portfolio manager about what cuts will mean for you, your money, and our own Fed correspondent, Jennifer Schonberger, going to talk about what really goes down at this meeting, or at least a smidge of what goes down there. I'll give you a hint. Cowboy hats, they certainly are worn. And Wall Street is debating the health of the U.S. labor market, but while they do that, we want to help you find a job if you are looking. I'm going to talk to a career coach who's going to give you the 3 things that are likely to land you a job. Plus, inherited IRA rules are changing. We'll tell you everything that you need to know to make smart tax planning decisions. All of that and much more. But first, let's get into this. The US dollar has been trending downward in the last few weeks, and a weaker dollar actually might just be a good thing for consumers here. Here to weigh in, we've got Catalyst co-anchor Madison Mills. Hey, Maddie.
Hey, Brad. So listen, I'm going to break down the pros and the cons here. It's a little bit complicated, but just stick with me and we'll get through it together, right? So the impact of a weaker dollar, it can kind of be a mixed bag for consumers. Let's start at the thing that I think matters most to our audience, which is the impact that a weaker dollar could have on inflation. That's the raising of prices for everyday goods. So the weak dollar can lead to higher prices on imports from abroad. We know so much of the products that we're buying every day are not made in the U.S. If you do have a weaker dollar, that can lead to higher prices on those goods that are imported. That can be more expensive and lead to more inflation. More inflation, not good. Obviously, that's going to be the key thing to watch as you head into Jackson Hole tomorrow, by the way. But again, weaker dollar potentially fueling inflation for those imported goods. If your dollar is not going as far abroad for companies, it's also not going to go as far abroad for individual consumers who are looking to travel, right? Get your international travel in now before we see the dollar coming down even more on anticipated Fed rate cuts, because your dollar can go further abroad if it is a stronger currency than the place you've been going to. That's why so many people have been talking about traveling to Japan over the past couple of years, because the yen has been so much weaker compared to the dollar. And that's also, by the way, what leads me to my last point here, which is if you do want to become an investor that's looking into trading currencies, getting into global investment opportunities, this could be a good opportunity for you if you utilize the weaker dollar to get into assets abroad. Think foreign stocks, foreign bonds, even foreign currencies. You can use that weaker dollar, trade into something a little bit more expensive. And when you sell out and convert that back to the dollar, you're going to be making even more money. That's exactly what happened with that unwind of the carry trade that happened a few weeks ago and led to the market rout in the U.S. So many institutional investors were doing the exact trade that I just mentioned with the dollar yen that it led to a little bit of a sell-off in markets when the Bank of Japan did raise interest rates. So it's going to be really critical for you to watch what central banks globally are doing if that's an investment opportunity that you want to get into with a weaker dollar. Of course, not giving financial advice on that, but it is an opportunity for investors. So again, just to summarize here, the totality of information on a weaker dollar, yes, it can raise costs for consumers when it comes to individual goods. And yes, it can make traveling abroad a little bit more expensive. But from an investor perspective, it does present a potential opportunity for unrealized gains if you are looking at investments abroad, Brad.
All right, I got to go back on my trip planning website to make sure that I can book that vacation.
Go to Japan now. Let's go.
Yeah. All right. Show's done, everyone. Maddie, thanks so much. Appreciate it. Now we're taking a look at how consumers are spending their cash here. First, Peloton seeing a slight sales increase for the first time in 9 quarters. But the reason why isn't necessarily because people are buying the fitness company's brand new top-tier bikes and treadmills, but instead, get this, they are buying pre-owned ones and paying for subscriptions at such a pace that the refurbished inventory is no longer sufficient to continue offering this as an option. So it's been sunset as of August 1st. The company is also anticipating a continued sales headwind as a result of an uncertain macroeconomic backdrop. However, the results were better than expected and better than feared, and so shares of PTON are up. Also up right now, Walmart. Elsewhere, Walmart, you've got them joining forces with Burger King. Starting today, Walmart Plus members can get 25% off at any Burger King digital order here. Now, That's not all. Members can also get a free Whopper every 3 months with any purchase. But as the old adage goes, there ain't no such thing as a free lunch. And so too, there's no such thing as a free burger. A Walmart Plus membership costs nearly $100 per year, or about $13 per month. And wholesale shoppers are increasingly going digital. The latest quarterly results from BJ's Wholesale Club revealed 22% year-over-year sales growth on its digital channels, while the company marked the 10th consecutive quarter of traffic growth. We should note the combination of major investments back into the business, plus a period where members' dollars are stretched. That leads the CFO to believe that the earnings per share will pressure margins and only reach the low end of the expected range that's been provided to investors here. Shares there are moving lower by about 7.25%. Let's check in on the equity markets here. Stocks trading near the flat line, lower as investors await Fed Chair Jerome Powell's big speech in Jackson Hole Friday. As part of the Fed's annual economic symposium, investors are hoping to gain a little bit more insight into which rate cuts and what type of rate cuts are expected this fall. Here to weigh in on what a rate cut means for your portfolio, we've got Francisco Beto, who is the FM Investments Head of Quantitative Research and Portfolio Manager. Great to have you here with us. So let's just start there. Broadly speaking, broad strokes, what do rate cuts generally mean for people's portfolios?
Well, in general, that's going to imply a reassessment of the valuation models and so on. So in general, the stocks or equities in general look more attractive as rates start to go down. And of course, consumers do benefit from this, retail and, and even corporate expenditures, CapEx expenditures and so on. As corporations, figure they can spend more on computers and whatnot, refinance your home. There's a lot that happens when interest rates go down or get cut a little bit. So that's going to benefit the economy in general.
Is there one major portfolio pivot that you anticipate investors might enact, or that investors would be apt to make sure that they are rolling out in terms of their own strategy once we do get a sense of how long that cutting cycle is going to look like?
Sure. I think investing in well-established companies like Home Depot, it's a given. We own Home Depot on several of our strategies, as well as one of the Magnificent Seven, Amazon and so on. They are solid investments long-term. In terms of Home Depot, they provide a dividend, and any hints of inflation, they can pass it on to the consumers and so on. And it's a very well-run company. So Home Depot is attractive to us. And likewise, given their earnings Target and Walmart, they already popped some, but, there's still a lot more to go there as well.
What do you think the thing is that Fed Chair Jerome Powell could say during his Jackson Hole address that would change the tenor for the market so that the markets would latch onto the most?
I would say perhaps reinforcing the fact that there is a softening in labor markets and acknowledging that the Fed is data-driven. So that would hint, investors, hey, I'm looking at the data, which we know they do, but, it will be something like that. I'm not so much into reading ahead of, trying to read the tea leaves or anything like looking for clues. I would like to see the data. And the best way to do that is really position yourselves independently of what the Fed might or might not do. And the way that we do that is by focusing on earnings and revenues acceleration. Look at the numbers. If a company can generate, increase in revenues and, increase the bottom line at an accelerating rate despite inflation, then that's a good company to hold. If you just go by that, then you're not so concerned about what Powell might say or not say. But in general, if he gets hints about the data about labor markets, I expect the market to pop up.
Does the data from what we're seeing thus far indicate to you that the Fed will be able to avert a recession?
Oh, absolutely. I don't think it's that bad. I think a slight slowdown at this point in the cycle is expected, especially coming out of COVID and so on. And remember, the bears out there who have been calling for a crash landing haven't seen that. Eventually, they'll be correct. There will be some kind of crash landing, but, market has been good at predicting the last 5 recessions, out of the last 3 and so on. So we know how that goes.
how do you expect the markets then to react to today's Fed minutes? Because that'll just be kind of a backwards looking kind of vibe check, if you will, from the previous meeting versus what we hear from Fed Chair Jay Powell on Friday.
Well, I expect more of the same. It will maintain itself in the neutral zone. They want to hear the real deal. They want to hear from Powell first for any clues or hints, and take it from there.
Francisco Bito, thank you so much for taking the time here with us today. FM Investments, Head of Quantitative Research and Portfolio Manager. Appreciate it. Well, inflation may be moderating, but consumers out there, they are still struggling as prices on goods are about 20% higher than they were in February of 2020. Couple that with a cooling labor market. So how important would a rate cut in September be for the consumer? For more, let's welcome in Konstantin Yannelis, who is the University of Cambridge Janeway Professor of Financial Economics. Thank you so much for hopping on and taking the time with us, Konstantin. First and foremost,
thanks so much for having me.
Absolutely. You just heard our discussion, and perhaps I'll pick things up there just about the recession risk and, of course, how the consumer would foreseeably navigate through any severe downturn that we were to see.
Yeah, so I wouldn't necessarily predict that a recession is going to happen, but there are dark clouds over the horizon right now. So, for example, major retailer Macy's just reported that they missed revenue forecasts and sales fell by 3.8%. There are even more mundane examples. So Disney, for example, reported weaker than expected theme park revenues. This is one of the easiest things for people to cut from their budget if they're expecting harder times, things like trips to theme parks, trips to Disney. So the thing we have to keep in mind is that American consumers are still feeling the lingering effects of inflation. Even though inflation is falling, inflation is in a sense sticky. And what I mean by that is that prices are still a lot higher today than they were in 2020 before the pandemic. They're about 20% higher than they were in February 2020. And these price increases have caused real wages. What I mean by that is income after we adjust for the rise in the price level to stagnate. And consumers were doing fine post the pandemic because there was massive government support, things like stimulus checks, enhanced unemployment insurance, the Paycheck Protection Program. However, all of that is wound down, and now many households that didn't see wage increases are still struggling with these higher prices.
With all of this in mind, I mean, we're looking at credit card debt that's just hit $1.14 trillion here. What do you take away from the way that consumers are spending right now, where they're still being able to deploy cash versus where they are leaning on credit card debt, or leaning on credit, I should say more broadly?
Yeah, it's not surprising that credit card debt has been surging given everything that's going on in the economy. We already mentioned that real wages have been stagnating or even falling a little bit, as many households just haven't seen wage gains that kept up with inflation. As a consequence of this, a lot of people are just struggling to keep up with higher prices by borrowing more on credit cards. They're also paying more in credit card debt because of the revolving nature of the debt. Interest rates are much higher than they were a couple of years ago, and that means that credit card payments are higher. So it makes sense that we've seen this huge spike in credit card payments.
You know, it's really interesting, especially as we consider where some of that credit card relationship initiates. And for a lot of people, it initiates during college, while you've got a mix of other expenses that you're starting to take on too. And we know a lot of our viewers, perhaps on the way back to school, trying to get their heads around, where do they need to tap credit versus, paying down other expenses and debt that are more pertinent and more timely for that education. We also know that there's been massive waves and tranches of money put forward, capital put forward by the government to make sure that student loan debt is being tackled. Where do we stand as of right now?
Yeah, so now we've seen for the first time large-scale student loan forgiveness. This has been a major boon for many households. About 8% of outstanding student loan balances have been canceled or forgiven by the Biden administration. And actually, for the first time in history, at least for the first time since I've been around, American student loan balances are actually going down. And this has benefited over 3 million borrowers who had full or partial loan forgiveness. Now, this has certainly had effects on spending, and some of my new research studies this, but these effects are fairly small relative to the size of the forgiven debt. And we find in our study that for every dollar forgiven, households spend about 43 cents in the short term. And the reason for this relatively muted spending probably has to do with the fact that most borrowers actually still aren't paying down their loans. So student loan payments were paused at the beginning of the pandemic in April 2020, and they sort of resumed last October, but they only sort of resumed because payback is still optional for another few months. What I mean by that is that borrowers don't go into default or become delinquent if they don't make payments. Interest just starts accruing. So many borrowers are still not making payments. And the upshot of all this is that what student loan forgiveness is actually doing for most people is forgiving payments that are well into the future. So we see more muted effects on the economy today.
Certainly. Just lastly, while we have you, Konstantin, what are the net effects that you expect for the mindset of consumers once we start to get a little bit more clarity around the rate cut pathway here, essentially trying to figure out the behavioral economics of the rate cut, if you will?
Yeah, I never like to predict perfectly what the Fed is going to do, but I think the data is showing that a rate cut is looking increasingly likely now. So inflation is still above the Federal Reserve's target of 2% at 2.9%, but it's been falling quite sharply, and this is the lowest reading since 2001. At the same time, the labor market is cooling. In the latest unemployment release, the unemployment rate rose to 4.3% from 4.1%. And this is not a massive increase, and unemployment is still pretty low by historical standards, but it's a sign that the job market is cooling, and hence the Fed would be more likely to cut rates. And falling inflation in a cooling labor market is something the Fed will look at in terms of cutting rates, likely in September at the next meeting. And this would definitely be a boon for many consumers, especially those consumers who are looking to purchase a home or a car, or who are forced to buy when rates were high and want to refinance their homes. That'll mean lower monthly payments and more money available for consumer spending. And this will be a huge benefit for first-time home buyers. So for many young people today who want to buy a home, it's just unaffordable because interest rates are so high. And if rates go down, that means lower payments for them, and that makes home buying more affordable.
Konstantin Yannelis, who is the University of Cambridge Janeway Professor of Financial Economics. Thank you so much for taking the time here with us today. Appreciate it. Everyone, we've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Here's a live look at Jackson Hole, Wyoming. We're going to have a live update from there. Beautiful look at some boats, mountains, trees. You can already smell and feel and breathe the crispness of that air. Crispness, not Christmas. We'll see you. Get ready for this one, folks. The Fed is kicking off its annual economic symposium today, and the stakes are high. Investors want to know more about a potential rate cut coming in September. But according to our Fed correspondent, there's so much more to this event than what meets the eye. Yahoo Finance's Jennifer Schonberger is live on the ground in Jackson Hole. So, Jennifer, just lay it straight to us. Tell us what really happens at this symposium.
Yeah, let me give you the behind-the-scenes look here, Brad. Fed officials are descending today on Jackson Hole for the Kansas City Fed's annual economic symposium here at the Jackson Lake Lodge in the beautiful Grand Tetons, a confab dating back to 1982. Central bankers from around the world, policymakers, academics, and journalists all gather here to discuss the economy and monetary policy. Tonight kicks off with a swanky dinner. Friday, Fed Chair Jay Powell will give a keynote speech. Traditionally, Fed chairs have used their Jackson Hole speech to deliver an important policy message. Former Chair Ben Bernanke used it to lay out QE. Powell could use the platform tomorrow to further set the stage for the first rate cut since the pandemic at next month's policy meeting. But he could also take a step back and dig into a topic that's germane to the current economic environment. This year, the theme is reassessing the effectiveness and transmission of monetary policy. It will explore lessons learned from the response of monetary policy to both the pandemic and the subsequent surge in inflation. During the day, Fed officials will hear from top economists who have penned papers around this topic and others. In the afternoon, officials generally take a hike in the Grand Tetons. Friday night, there's a cowboy-themed dinner with line dancing, though Fed Chair Powell says he doesn't sport cowboy boots.
Cowboy boots are worn by some, but not all. I don't wear them myself.
And why Jackson Hole? Well, the Kansas City Federal Reserve then needed to lure Fed Chairman Paul Volcker, and the way to do that was to try to figure out where they could find fly fishing in late August. And Jackson Hole it was then, and Jackson Hole it still is. Brad?
Jennifer, I just want to know, what line dances are they doing? Are they doing the electric slide? Are they doing the wobble? I mean, is it just some of the do-si-dos?
We'll see, Brad. They may be getting down. They may do the hoedown, right? Like, you know, I didn't bring any boots myself because I wanted to travel compact. But, you know, we'll see. You know, and other people they're sporting their cowboy hats here. There's a lot of Western gear to be seen around the grounds here.
Okay, all right. You let me know how much those cowboy hats are going for. I'll send you the Venmo immediately and size as well. Thank you so much.
You got it, Brad.
Appreciate it. Turning to the housing market here. Existing home sales growing 1.3% in July to a seasonally adjusted annual rate of 3.95 million. Now that 1.3% growth rate was in line with expectations. And here with more reaction, we've got Skylar Olson, the chief economist over at Zillow. Skylar, thanks so much for joining us here this morning. So first and foremost, I mean, just give us your read through broad strokes on the housing market as it stands right now, even with this latest data that's come through.
Yeah, I mean, this latest data was, I'd go so far as to say, a relief to come back to kind of the expectations that we are on a steady and slow recovery from those super low volumes of not just sales, but what often determines sales these days, which are new listings from existing owners, which honestly still remain incredibly low compared to pre-pandemic because interest rate lock-in is most certainly a thing. But we have been seeing that kind of steadily come back. June's existing home sales numbers were very disappointing. It showed a big slowdown from buyers. These July numbers are a bit more back to balance. That said, Zillow's data that captures things like competition between buyers and sellers. So think things like how many listings have a price cut, how fast homes sell, or even how many people we see searching Zillow relative to the number of listings available. That return of inventory coming back up slowly, that was also in the July report from NAR, shows that there's lessening of competition in the housing market, so maybe a better opportunity for buyers, particularly in the South. But then at the close of July, so over the course of August, we've since seen mortgage rates come down a little bit more. So let's meet next month and talk about whether or not that softening dynamic in the housing market is still even at play.
You know, it's really interesting. And one of my favorite questions with, economists like yourself is where you think the mortgage rate will need to get to in order to really entice a drove of buyers to come in off the sidelines and perhaps even some refinancing from those who are sitting on some very low rates right now.
Yeah, I mean, droves, if you want droves, we got to go all the way below 5%. Something that, we think about when we think about that tipping point rate, what it takes, right, to bring people back in. We could compare affordability. So what is that mortgage payment relative to income? As mortgage rates come down to 6%, in that range, at 20% down, the typical U.S. home is affordable to the median household income. So at that moment, you can see that a certain, employed, ready buyers who have had that savings are ready to go will certainly want to move forward. But in terms of that incredible, not just affordability advantage relative to incomes, but also compared to rents or staying in your apartment, pre the mortgage rate lift up, you would have saved $500 a month to become a new homeowner. These days, it's more in a wash. So if you want droves of buyers to return, if mortgage rates come down below 6, that's that advantage above and beyond renting that same home. But that's, as obviously there's a lot of nuance here. Any break in mortgage rates, when we see that affordability for that middle income American, is going to do kind of wonders for the buyer's ability to move forward.
So with that in mind, what is your anticipation for the cooler months in the back half of this year, where perhaps there are a lot of people going out to open houses right now, still some bidding wars that are being reinitiated here? What does that set up for the fourth quarter of this year in the housing market, especially knowing that everybody by then is going to expect to have seen the Fed at least cut rates once in September?
Well, and I think that last point is really what you're hitting on here, that it feels like there's a lot of behavioral elements going on with how people are trying to maybe strategize through the end of the year. So perhaps June numbers were so soft because during that time, there was a lot of language about, price cuts coming soon, right? So it's like anticipating this advantage later, I might be putting off the moves I would otherwise want to be making today. So let's say rate cuts are already probably drifting down, or now in like 6.5 ballpark range, and maybe they'll stay there depending, obviously tomorrow at Jackson Hole, we'll all be listening to find out. So if we continue to have confidence in that rate cut in December, if not September, then rates can stay to kind of this low level. Should we get, that break or continue to have breaks in rates, you might see mortgage rates drive a lot of their own seasonality because people have been maybe putting off or timing it, or have been unable to move forward and qualify because rates, went up so quickly, and they haven't yet had the chance to save up more of the down payment that they would need to access the same home that they used to want to target.
Skylar Olson, who is the chief economist over at Zillow. Skylar, great to have you here on the show with us. Appreciate the time and insights.
Thank you.
Certainly. Everyone, we've got much more here on Wealth. After the break, you're watching Yahoo Finance. The jobs market is front and center as the Fed's Jackson Hole symposium that you may have heard us speaking about kicks off. Recent data has exposed some weakness, though, bolstering Wall Street's calls for rate cuts. So let's break down why the jobs market is so important to the Fed and get to the truth about the health of American jobs here. Here with more, we've got Yahoo Finance's Morning Brief and Catalyst co-host Shauna Smith.
Hey there, Brad. Well, let's get to the truth and let's talk about what has been going on within the economy, because if you've seen those recent data prints, it might be a bit confusing. Right now, though, the conversation seems to be all about jobs. And why that is, well, it's pretty clear. We know the Fed has a dual mandate to promote maximum employment and stable prices. Now, for the last couple of years, the Fed has really focused on the inflation side of the equation, raising interest rates to a 23-year high in an effort to tame inflation. And by and large, many would say that their efforts have paid off, as we have seen a steady deceleration in prices. Now, on the flip side, the other side of that equation, well, that's the labor market. And right now, that is front and center. Much of this thanks to that weak jobs print that we got back in July. We also got the revision earlier this week on jobs numbers, and that's adding to that weaker labor market narrative. Non-farm payrolls were revised lower by more than 800,000. That was the largest downward revision since 2009. Now, I spoke with Omer Sharif. He's the founder and president of Inflation Insights. He, along with Evercore senior economist Marco Casaraghi, about their assessment of the economy. Here's what they had to say.
It does show that the labor market was a bit cooler than what we expected in the 12 months to March. But again, I think the key thing for the Fed is what's happened since then. That's the unemployment rate has risen to 4.3, higher than what they had expected for year end, which is 4%. I think that's going to be the more relevant issue for them.
If you zoom out, you see that the economy is slowing down but still growing. The labor market is softening, but it's not rapidly deteriorating. And so overall, this picture is more consistent with a soft but bumpy landing than a hard landing.
So what does Marco say that the data is more consistent with that bumpy soft landing narrative, maybe more so than a hard landing? Well, it is because some of that other data that I referenced earlier, strong retail sales showing that consumers, well, they're still out there spending. Initial jobless claims known as a proxy for layoffs and continuing claims, both of those figures relatively steady levels. But it is fair to say, though, that the recent mixed economic readings does have Wall Street split just on where exactly we stand. So we spoke to Ahmed Riesco. He's Insignia's chief investment officer, along with Joe Bruce-Suelas, RSM chief economist, about just that. Here's what they had to say.
We know that the U.S. consumer is doing okay, but the U.S. consumer is doing okay because they still have a job. The second that the employment market flips from one of surplus to one of deficit, which is something that we're rapidly nearing, we think the U.S. consumer, unfortunately, will falter.
I'm not sure what economy he's looking at because the American economy is now getting ready to flip. We needed to slow hiring down in order to return to price stability. We slowed hiring down. Price stability has returned to the U.S. economy. Federal Reserve is getting ready to cut rates, both to protect and preserve the soft landing, put a floor under the labor market.
Safe to say they don't agree on where things stand, but whether or not the Fed is able to put that floor into the jobs market, well, that is the big question. For consumers, for Americans, maybe many of you at home, well, you're a bit nervous about where we stand today. There's a new survey that was just released by the New York Fed, and that actually found that the number of people who expect, and these are expectations, to lose their job in the next 4 months, well, that actually just reached a record high, Brad, of 4.4%. So you look at the data, you can almost support any sort of argument that you're trying to make. Yes, there is reason to be concerned. On the flip side, there has been relatively steady, strong data that can support that narrative of a soft landing. But it's clear to say, and I think that New York Fed survey really drives it home. Americans right now, they are very nervous about what exactly their future looks like at their jobs. And many of them are preparing to potentially lose their jobs here over the next several months.
Yeah, net bracing. And if they're in that group of people that are concerned, we've got a conversation coming up for them. Shauna, thanks so much for breaking this down, setting the scene for us. Let's stick with our conversation on the labor market here. A new poll found that more than 28% of Americans are actually searching for jobs right now. This is the highest reading since March 2014, according to the New York Federal Reserve. And landing a job, it's not totally easy here. To discuss how you can secure your next dream job, we've got Phoebe Gavin. She is a career and leadership coach. Phoebe, great to have you here on the program with us. So you just heard us lay out some of the stats, the people that are concerned about losing jobs and those that are actively looking for positions. Where does the search begin? Where are the different sources that people can begin to tap into versus what we had seen in prior readings of those same figures, looking back as far as 2014 even?
Yeah, in a regular job market where things are a bit more balanced or even more pro-candidate, you can do just fine just going onto the regular job boards and finding a position to apply for, putting your application in, and feel pretty good about your chances of getting a call back and ultimately getting a job. And that is not the case in the current labor market. People are looking at much longer job hunts, much more involved applications, slower interview processes with more stages, and even less room for negotiation in terms of compensation. And so that's really resulting in a lot more pessimism for job seekers, especially in white collar jobs. And when we look at the granular data about the jobs that were, the job categories that were revised down, they very much reflect these industries that have a much more of a concentration of white collar jobs.
Now, Phoebe, we want to give some people some actionable tips out here as well. In addition of where to look, how can people tap into the network that they have as well already?
It is absolutely essential for you to use the network that you already have, talk to the folks that you already know, go through your phone, go through your email contacts, go through your LinkedIn, but also put effort into broadening your network. And the best way to do that is to join a professional association. It allows you to join online groups or attend events where people in your industry are there and thinking about work and connecting with other folks who work in that industry. It can be an opportunity for you to build your skills as well, because often these associations put on workshops or events that are meant for skill building. And then if you are a senior person in your career where you have skills to convey to others, you can grow your reputation in your network by teaching workshops or participating in panels. And so that's always where I encourage people to start first.
While we're on networking here, I mean, when you see, maybe this pops up in your feed, it pops up in mine all the time. It feels like there are more social groups that are dedicated to activities. How many people out there, how can people lean into these activity-based groups as well, where that might be sparking the conversation with someone who is in their network or maybe out of their network, but is something that's based around a common enjoyment of, I don't know, running or, going fishing, whatever people like to do, playing basketball these days, whatever.
That kind of stuff is great for your mental health, especially if you're finding it to be challenging to navigate the job market. It can be a little bit hit or miss in terms of networking from a professional standpoint, because you never really know if there's going to be that overlap. But that's part of the reason why professional associations can be so great, especially if they have online groups, because sometimes in those online groups, there are those more interest-based opportunities to connect with folks. And so you're already in an environment where it's all accountants hanging out talking about accounting, but maybe there's a subgroup of runners who are also accountants. And that sort of thing can be a really great opportunity for you to build new relationships really easy and have a lot of baseline foundation to connect upon. I'm a huge fan of professional associations.
Just lastly, while we've got you here, Phoebe, upskilling. Where should people be and how should people be prioritizing upskilling as they are looking for new positioning?
Be as focused as possible and build one bridge all the way across the chasm. So take a look at the roles that you're applying for and pay attention to the patterns you see and where you feel vulnerabilities in your own skill set, and invest in closing one of those gaps at a time. Put all of your effort into that one gap versus spreading it over lots of different possible skills. The more portfolio pieces and investments that you make in that particular skill, the easier it's going to be for you to close that gap, but only if you build the bridge all the way across the chasm.
Excellent advice, excellent insights. Phoebe Gavin, career and leadership coach. Thanks so much for taking the time.
Thanks for having me.
Certainly. Everyone, we've got much more on wealth after the break. You're watching Yahoo Finance. The new rules issued by the IRS are changing the way that you take your required minimum distributions from inherited IRAs. Now, required minimum distributions, or RMDs, are the amount of money that you need to start taking from your retirement accounts after you turn 73. So to break down what you need to know, we've got Joel Dixon, who is the Vanguard Global Head of Advice Methodology here. So let's just give people the lay of the land here. What is the current status quo, some of the rules around making sure that once the IRS rules take effect, that they are removing the right accounts from these IRAs?
Yes, well, Brad, thank you for having me today. This has been a topic long in coming, if you will. The discussion really started back with the so-called death of the stretch IRA back at the end of 2019, which meant for most non-spouse beneficiaries, you had to accelerate the amount that you were taking out of the inherited IRA kind of within a 10-year period. But exactly how that was going to occur was not certain. And so we've been waiting on these new rules to understand exactly what needs to be done. And basically for most non-spouse beneficiaries, you are going to have to accelerate your drawdown of the IRAs relative to what had been happening before.
It seems like this would naturally have a negative perception. What is the real perception that you've heard and seen from clients?
Well, certainly everyone thinks, hey, the longer I can keep money in a tax-advantaged account and avoid the tax bill associated with such elements, the better off we will be. However, that's not necessarily the case. And in fact, there's a silver lining to these new IRS regulations that requires maybe a greater acceleration of that money, which is that if you can avoid large distributions putting you into higher tax brackets in the future, it actually can make some sense from a total tax paid standpoint and even a total wealth standpoint to actually take distributions from an inherited IRA, maybe even more quickly than the IRS regs suggest. But certainly the IRS regs help to mitigate some of the risk that distributions in the future, if you were to just defer those distributions as long as possible, could force you into higher tax brackets and actually provide lower after-tax wealth over time.
What would be the advantage, or what's kind of the rule of thumb on if you should be drawing down even more than the threshold that is required?
Yeah, the main thing to look at, and it gets a little complicated, and so working with a financial or tax advisor may actually be useful for your individual circumstances. But there are many cases, and we see this with normal required minimum distributions for your own personal IRA, say in retirement, where the distributions could be large enough to push you into a higher income tax bracket, which means the money that you're receiving from that distribution is taxed at potentially a higher rate than normally you would be subject to. And so you can smooth that out over time by managing distributions more carefully over the life of, let's say, your retirement, or in the case of inherited IRAs, maybe spreading them a little bit more equally over the 10-year period over which you have to distribute the IRA.
Joel Dixon, who is the Vanguard Global Head of Advice Methodology. Joel, thanks so much for taking the time here with us today.
Thank you, Brad.
Certainly. We've got much more wealth after the break. Stay tuned. You're watching Yahoo Finance. Let's get some finance in your feed. How about that? You may have seen some of these pictures on your social media feed. That is, or rather was, a vintage Ford car valued at over $1 million. Now, it caught on fire on its way back from being displayed at the Monterey Car Show in Pebble Beach. Well, guess who else was at that show? Our very own Pras Subramanian was at the car show with some pricey vintage and modern cars, one of the biggest alternative asset classes here. I mean, you saw this at the show here, but you've got some other takeaways as well. Like, what was the vibe there?
So real quick, they had a wedge-shaped car, special class at Pebble Beach Concours, and that Ford Probe designed by the Italian design house Gia was there. Looked kind of funky, super 80s, early 90s kind of design.
Yeah.
So I saw it. I was interested. I think a picture of it too. I should probably send it to you guys later, but I saw it the next day being transported, caught fire. They don't know why, but it's a total loss for the car. Really, one of one car. You can't really recreate that, so really sad. But speaking of that classic car market, you know, it was a big weekend of auctions that week, right? So a lot of expectations. Hagerty was looking at probably a $460 million total outlay in terms of total auctions. Came in at 391, 392, kind of a big miss there. A big miss from what people were expecting. A lot of the higher end $1 to $5 million cars, including Ferraris, didn't sell. Sell-through rate went from 62 to 52%, 10% cut. Wow. So a lot of concern that is there a correction happening in that classic car market? It's been rising a lot steadily since post-pandemic, or since the pandemic, so maybe that's why. And maybe we're seeing a little correction there.
Yeah, I heard a certain car maker giving more customization options as well. I mean, what can you tell us about that and how people or buyers are leaning into that customization?
So we saw a lot of this there with a lot of the newer automakers in the luxury space saying, how do we stand out? We got to customize, offer one-off type of designs.
For millions of dollars in spend, of course.
Yeah. Well, do you want a custom like embroidery on the on your headrest, things like that? So Bentley, I spoke to the Bentley CEO. They noticed that their cars are pretty hot, but they have a kind of a older sort of name, but what's happening is that they're bringing younger buyers with better designs, more sporty designs, but also the younger buyers want customizations. They want special exhaust kits. They want different colors, stitching, types of work on the dash. So they even have an option for a stone inlay for the dash, right? So these kinds of things are the increased profit margins, but also bringing a younger buyer, going from 60s to 50s to 40s now, late 40s. So good for them.
All right, a lot of hodlers or Bitcoin, perhaps, remittances that might be coming into these vehicles as well. Pras Subramanian, thanks so much. It looks like you had a great time out there.
Yeah, it was great. It was so banging articles, you know, stick to Yahoo Finance for more.
Okay, enjoying it. Thanks so much, Pras. Let's do a final check of the markets here as we end this hour. Taking a look at the Dow Jones Industrial Average right now, we're down by about 0.4%. We're seeing some slippage across the S&P 500 and the Nasdaq Composite as well. The tech-heavy average down by about 1%. The S&P 500 down by about 0.6%. That's it for Wealth. I'm Brad Smith. Thanks so much for watching. Stay tuned. Market Domination with Julie Hyman and Josh Lipton comes up 3 p.m. Eastern Time. You don't want to miss it.